if you look at the actual valuations, we're not talking pets.com moment. In other words, these are now the stalwarts that ultimately I view. When I look at Microsoft, I could argue this is a $3.5–4 trillion company in the next 2 to 3 years. I think the difference when you go back to the bubble in 99, 2000, I mean, a lot of that was hype. This is different because the fundamental and the real business cases are there. I'm not saying, there's not going to be froth and losers that fall by the wayside, but I believe this is an AI gold rush. It's real. And that's why this week, I think the bears go back into their hibernation mode after how little win last week to what's been a brutal 6 months for them.
Hey, Dan, in the context of this AI discussion, it's going to accelerate once again this week with these earnings. How does Apple fit into an AI discussion?
I mean, they are not going to be on the outside looking in. When we've talked about it, I mean, they're spending almost the equivalent of what Microsoft did with OpenAI internally on AI. This is all the drum roll to what I believe, I mean, Gurman's hinted at a bit, they're going to roll out AI within their ecosystem. I ultimately believe it's an AI app store for Apple, which I believe could add $30 to $40 per share. And again, Cook continues to play chess while others are at the kids' table playing checkers.
Wait, say more about the AI app store. What are you anticipating?
A separate app store that's going to be AI-driven developers. I believe it started off with Vision Pro in terms of, actually building a separate almost app store. It's going to be AI-driven. Health, fitness, AI apps will be in that app store. And then for Apple, that's just going to be a whole nother opportunity to further penetrate the base that has an unparalleled install base. And I believe right now the valuation is not reflecting what I'll call AI multiple. And that's why I believe this is a $4 trillion market cap by 2025.
Dan, you mentioned the headset, and this earnings call is going to be the first time folks have the opportunity to ask Apple about that headset. Do you think they're going to get killed for investing in a headset when people have moved on to focusing on AI?
Because ultimately it's not about the headset. Because my view is that this is really just to start AR, VR to what ultimately is going to be the next vision around AI. And that's going to be integrated more and more within that ecosystem for Apple. And I think ultimately investors are focused more on iPhone 15, where we think ultimately units are going to be higher and this is a mini super cycle. That's the long game. Right now it's all about developers build out for what I view as sort of the next evolution of the Cupertino ecosystem.
Hey, Dan, I just want to talk Tesla for just a moment because Bloomberg News, Stefan Nicola is out with a great story saying Tesla is lapping Germany's automakers in the global EV race. And so, we heard from all the big German manufacturers over the last several years how they're going all in on EI, but Tesla delivered almost 890,000 cars in the first half of the year. That's more electric vehicles than Volkswagen, BMW, Mercedes, or Porsche combined. So how do you think about Tesla and just kind of their competitive positioning as everybody else tries to ramp up?
I mean, it's Tesla's world, everyone else paying rent. If you look at electric vehicles and from a scale and scope perspective, battery technology, supercharger, and I ultimately believe FSD AI. That's why I think last week, you got the knee-jerk sell-off after just a parabolic move this year. I think this is still early to middle innings of the broader Tesla story building out. And this EV green tidal wave, the $5 trillion green tidal wave, there's going to be many winners. The 313 area code GM4, the European players, a lot of the China players. But ultimately, if you look, the biggest beneficiary is going to be Musk and Tesla.
Really quickly, Dan, are you team Twitter, formerly, or now X, formerly Twitter, or team Threads?
Oh, I stay Twitter. And again, I go back to Threads. I'd rather eat broccoli for the full day than be on Threads.
Very good. There
Love
you go.
It, Dan.
Conviction, if nothing else. Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Securities. Appreciate getting that roundup on tech because, again, a big earnings week here for a lot of industries, and most notably tech, and is the biggest sector in the S&P. You like to see tech companies put up some decent numbers because the stocks have really ripped. Again, the NASDAQ up over 30% just year to date. So really discounting better numbers, and we'll see if these companies can deliver that this week. All right now, let's head down to Washington, D.C. We're going to get world and national news with Nathan Hager.
Paul, big moves in Israel. The country's Knesset has approved the new judicial oversight law that would weaken judges' power to overrule government decisions. The vote comes after months of protest and a late plea from President Biden. Bloomberg's Anne-Marie Horton has more from Washington.
Axios has a statement from the president saying basically a nod to hoping that Netanyahu would back off on this and saying that what Israel needs to do is something we've heard from Washington, D.C., is find consensus.
Bloomberg's Anne-Marie Horton in Washington. Now, the vote on this measure was 64-0. The Knesset's 56 opposition lawmakers walked off the floor in protest of the vote. The United Nations Command has begun talks with North Korea's military about the U.S. soldier who crossed into the border from South Korea last week. It has been nearly a week since Private Second Class Travis King walked into North Korea after being released from a South Korean jail on assault charges. House Foreign Affairs Chairman Michael McCaul says King made a serious mistake.
The question is he defecting? I think it was more running from his problems. That was the wrong place to go.
Congressman McCall was on ABC's This Week, which you can hear Sundays on Bloomberg Radio. Russia attacked one of Ukraine's ports on the Danube River overnight. That's according to a Facebook statement from Ukraine's military. It didn't say which port or give more details on the damage. The Danube is the last major export route for Ukrainian grain after Russia ended the Black Sea port deal. Greta Thunberg has been ordered to pay $240 in fines for disobeying police. The Swedish climate activist was with a group that had to be removed by force last month for trying to block fuel trucks at a southern Swedish port. Thunberg made a brief court appearance this morning. That sentence, reported in local media, is typical for a disobedience charge. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major averages right now all higher at the start of a busy week. We have earnings, heavyweights including Alphabet, ExxonMobil, Meta. They're all due to report this week. On Wednesday, of course, the Fed expected to announce another hike in its benchmark interest rate. And meantime, Ian Shepherdson at Pantheon Macroeconomics expects U.S. growth to slow significantly.
The restarting of the student loan payments in October, I think, is going to really dampen U.S. consumption in the run-up to the holidays. And I think the little pop we're going to see in business investment in the second quarter in the U.S. probably isn't going to be sustainable either. So, yeah, I'm very much on board with this idea that the real growth picture is pretty poor everywhere.
Well, right now, the S&P 500, 16 points higher. That is up 0.4%. 45.53 on the index. The Dow Jones Industrial Average is up 161 points. That's a rise of just under 0.5%, and the Nasdaq 100 up 25 points. That is up 0.2%. Dozens of drugs made by New York-based Pfizer may be more difficult for hospitals to purchase. That's because they are manufactured at the company's North Carolina plant that was damaged by a tornado last week. And then, of course, Mattel shares rising after Barbie became the top-grossing picture in U.S. and Canadian cinemas over the weekend. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Madison and Paul.
All right, John Tucker, thank you so much. We appreciate that. As always, Madison Mill, Paul Sweeney, here in the Bloomberg Interactive Broker Studio. We're streaming on YouTube. Just head over to YouTube and search Bloomberg Global News, and that'll take you right to it. Let's get to this market here. I mean, we're getting into the teeth of earnings this week. But you got markets that have just been really on a tear. We got the S&P 500 year-to-date up 18%. Yes, it's not as broad as you'd like to see it in terms of the number of companies participating. But you take a look at the NASDAQ. That's up about 34% year-to-date. So when you come to these earnings, the question is, boy, they better deliver. How is sentiment out there? Ross Mayfield, investment strategy analyst for Baird, joins us. Ross, how is sentiment out there in the marketplace, after such a strong first, 7 months to the year?
It's improved a lot. It's a bit more mixed now. Certainly, we were at kind of peak pessimism last fall, right around the time the market bottoms. Inflation's coming in hotter than expected at every report. The Fed is ramping up their activity, going from 25 to 50 to 75 basis point rate hikes. So it's improved a lot, right? The survey data has gone from bearish to bullish. Put call data says the same kind of thing. You look at something like ETF inflows, you're starting to see investors come back into the market. But at the same time, I mean, just anecdotally, it doesn't feel like there's 100% buy-in. There's still a lot of skepticism about the market, whether because of narrow concentration or just because there's so many macroeconomic headwinds still out there, the same ones that people expected to cause a recession in 2023 that haven't really borne out yet. So you still have a skepticism. Money market assets are still at 5-6 trillion, which is well above where they were pre-COVID. And then you look at some of the manager or fund manager positioning, and it's still positioned defensively, somewhat bearish. So improved, but still mixed, in my opinion, and not enough to really derail what has been an ascendant bull market this year.
So would you say, if you had to put a calculation on it out of 100%, where are we in terms of skepticism versus euphoria right now?
Yeah, so it's the old John Templeton quote, right? So I think we're somewhere in between skepticism and optimism. So maybe at 60%, something like that. I certainly, you can feel euphoria in little pockets of the market. The AI space is pretty notable this cycle, but it still doesn't feel necessarily as over ecstatic as it did in early 2021 with the meme stock mania or the SPACs or crypto. And also, the AI stuff is much more tangible. It's real. It's on earnings calls. Companies are investing today and providing, monetary results today. So I think there's a little euphoria around the idea, but it also feels a lot more real. And it doesn't feel quite as crazy as early 2021 did in that trading boom. So I think there's still a broad skepticism about this rally, and maybe not all for bad reasons. There are certainly still economic headwinds out there that could derail the market at some point or the economy at some point. But it still feels skeptical. And I would say the pockets of euphoria are small and not all that concerning.
Ross, a big week for earnings coming up here for a lot of big companies, including the tech space. What are you looking for? What do you need to hear to kind of push this rally further?
Right. Well, to continue on the AI point, I mean, a big part of the rally and expansion of valuation, which is what this rally has entirely been, particularly in the tech space, is based on the idea that at some point soon, AI will drive tangible results to these companies. And so the question you have to ask is how real is that? What are the investments today? Are you investing in CapEx? Do you have, guidance on 2024 and 2025? Is it going to hit your bottom line? So I think for the big tech companies that are, the big chunk of the market that have been leading the rally higher, it really does come down to what is the guidance on AI? What is the guidance on the spend? And how soon can it be adding to your bottom line? I think that's what the market cares about. We know these companies are, debt low, cash rich. They kind of, a lot of them print money in a sense. But this recent rally up needs to be sustained by the AI boom being real. And so we're going to be looking for guidance on that front.
Well, it's interesting because you are seeing companies that missed on profit margins like a Tesla and a Netflix getting punished in the market reaction. Do you read that as a leading indicator of the, growth story getting a little bit old for investors to bet on anymore?
I don't think so. I mean, I think there's certainly reason to see a pause here after the run-up we saw across the spring months. Margins are especially in focus given all the inflation and rate talk. So missing on a key item like margins is going to be maybe punished a little bit more. I do think also that the bar was a bit higher heading into this earnings season. So, estimates were cut, but not nearly as much as they are on average. So you have a higher bar to clear. Companies that are kind of meandering by are not going to be rewarded with that next leg higher after their valuation has already expanded so much year to date. So I think there just needs to be more follow through. And Q2, is widely expected to be kind of the trough in earnings and maybe the trough in margins as well. So as long as that forward guidance kind of holds in there and the market buys it, I think most of these companies will be okay. But the market is expecting real results on the AI front sooner rather than later. And especially some of the companies tied into that trend a little more closely are going to have to deliver.
Ross, I'd love to get your thoughts on valuation here. I'm looking at the Bloomberg terminal. I've got a PE ratio on the S&P 500, kind of like 18 to 19 times next year's earnings. Are you concerned at all about the valuation of this market, maybe a little too far ahead of itself?
It's tough, right? Because valuation is not a really good near-term timing tool by almost any valuation metric you can throw in the market. But sure, you do have to, if you're going to have an extended valuation, especially at this point in the cycle with all the economic headwinds, with rates where they are. I mean, I think that's been the biggest point of surprise or concern maybe is that as real rates have risen, so have valuations in the tech space, and that's the exact opposite of what we saw last year. So you really have to deliver to grow into these earnings. And I do think that's a high bar to clear. AI is a durable, tangible theme for these tech companies. But as with most of these things, we tend to overestimate what it's going to do in the near term, maybe at the expense of underestimating its long-term potential. But in the near term, there's a lot of, earnings growth that has to be delivered to justify these multiples. X tech and X kind of consumer tech, the market looks a little more reasonable, but it's still probably extended for where the short rates are, where the Fed funds rate are, especially since the Fed has not done hiking. So I think it is a bit of a weight, or at least somewhat caps, upside return potential. But we also know it's a really bad near-term timing tool. And so we're not going to let it, affect our decision-making too much for the next 6 to 12 months.
All right, Ross, great checking in with you. Ross Mayfield, investment strategy analyst at Baird, another Milwaukee person.
You love Milwaukee
pound
guests.
for pound, pound for pound. I think some of the smartest investment folks are in Milwaukee. I have no idea why, but we're going to be chatting with another one of those, Ann Maletti from Allspring, coming up, one of the all-time faves there. Looking at the market here, solid. Let's call it solid. Up 0.4% on the S&P. The NASDAQ up about 0.1%. The Dow, I'll quote that for Jonathan Farrow, up 0.5%, 176 points, solidly above 35,400. So we'll take that. So a good start to the week, a big earnings week, including some of those big tech names that we highlighted earlier. So we'll stay on top of that, as we like to do here at Bloomberg. More coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Stellantis, and Samsung have agreed to build a second U.S. battery plant. Last year, the companies announced plans to build a $2.5 billion battery facility in Indiana. No word on a location for the second plant, though. Shares of Stellantis up more than 1.25%. Meanwhile, shares of Tesla up less than 0.25% after the company announced it's unveiling an 84-month auto loan. Bloomberg's Sue Keenan says CEO Elon Musk hinted about plans for the new 7-year option during an earnings call earlier this month.
He has not been a fan of the Fed and its increasing interest rates. He said that when interest rates rise dramatically, we actually as a company have to reduce the prices of the car, he says, because the interest rate payments increase the price of the car.
Thanks, Sue. United Parcel Service and the Teamsters will resume their contract talks tomorrow, just 1 week ahead of the strike deadline. Bloomberg's Lisa Mateo has more.
UPS says the two sides will negotiate the few remaining open issues and that it's committed to reaching an agreement before the current contract expires at the end of the month. The Teamsters says it walked away from the talks on July 5th because it was not satisfied with the company's offer on part-time wages. Without a tentative agreement, the union said it will call a strike August 1st. Steve?
Thanks, Lisa. Shares of UPS up less than 1%. The NBA Board of Governors has approved Michael Jordan's sale of the Charlotte Hornets. Sources tell the AP the team will go to an ownership group led by Gabe Plotkin and Rick Schnall. The decision ends Jordan's 13-year run as a majority owner of the franchise. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. I was just looking at WTI crude oil. It's at $78 a barrel right here. It's had a big move up. And you think about it, over the last 12 months ago it was about just under $68 a barrel, but here we are at $78 a barrel, so almost a 15% move in WTI crude oil. Keeping an eye on that, up another 2% today, $78.67. So crude oil on presumably the expectation of stronger demand out there as we take maybe the recession off the table a little bit, at least here in the U.S., giving some movement there to that commodity. So we'll keep an eye on that. S&P up 0.4%, NASDAQ up 0.2%. Right now, let's head down to Washington, D.C. We'll get rolled to national news with Nathan Hager.
Paul, protesters are back out in force in Israel, chanting slogans, honking horns, while inside lawmakers approved the bill to limit judges' ability to override government decisions. It is part of a broader plan from Prime Minister Benjamin Netanyahu's government to restrain Israel's judiciary. Opposition lawmakers left the Knesset floor in protest and were not present for this vote. That allowed the bill to pass 64-0. Nearly a week after a U.S. soldier crossed the border into North Korea, the United Nations Command has begun talks with North Korea's military. Bloomberg's Amy Morris has details from Washington.
23-year-old Private Second Class Travis King was whisked away by North Korean military personnel, but there hasn't been any information about his status from North Korea at all, not even a mention in their official media. He's likely facing intensive interrogation somewhere in Pyongyang. The deputy commander for the UN command says the primary concern is King's welfare, so they have started discussions through the mechanisms of the armistice agreement, the ceasefire deal that ended fighting in the Korean War. In Washington, I'm Amy Morris, Bloomberg Radio.
The heat around the world is unrelenting. About 40 million Americans are still under heat watches and warnings. In Europe, wildfires in Greece forced about 19,000 people to evacuate the island of Rhodes over the weekend, including this woman.
Literally 2 hours after we left, they were covered in ash. Just sat on their own balconies, looking over at the pool. They'd be covered in ash. And the moon was red and everything. It was horrible.
And right now, more than 160 fires are burning across Greece, and the Italian island of Sardinia is expected to reach a record high today. The hazing scandal at Northwestern University is growing. A volleyball player identified as Jane Doe has become the first female athlete to sue over allegations her coach retaliated against her for reporting an incident in 2021. The lawsuit says she caught COVID despite following team guidelines, but says 2 coaches forced her to run suicide drills as a punishment while other coaches and team players watched. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg. Paul and Madison.
All right, Nathan Hager, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. Barbie and Oppenheimer moving stock market.
I just dropped my coffee all over my cell phone.
But we had the lid on, so that's good.
Exactly.
So, Anthony,
a classic Monday morning move. But yeah, to your point, Paul, Barbie moving the stock market. And I was asking you about this earlier because IMAX is surging by over 6%, Cinemark over 3%. And I asked you, how long does this last? And what you said was
usually it lasts kind of a relatively short time. I mean, kind of what the stocks are saying here is, we've got some new news in the marketplace. Let's reprice these shares. But it was, better than expected results coming out for these two movies, which is great. Yeah. The thing I think was really interesting was called out by an analyst at B. Riley Securities, an analyst, Eric Wold, who's been following these stocks for a long time. He liked the fact that it was non-sequel titles can drive consumers to the theaters. And, that was a little bit of an uncertainty coming out of the pandemic because everybody, Hollywood in general, is trying to get a handle on, will consumers go to the theaters? What types of titles will get them into the theaters? Yeah. And we saw some, tired franchises, if you will, coming out of Walt Disney and Warner's and things like that, causing them to pause or delay some of the releases over the next several years. But these two new movies, new characters, new stories, just pushing it.
Yeah, and I'm betting very bullish on a Barbie sequel.
A Barbie sequel?
Yeah, for sure.
Because you're a big fan. You said you love the movie. Well, check it out. I definitely want to see the Oppenheimer movie in theaters. Hoping I can make that happen. All right, we're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to talk earnings, but we're going to talk about some of these big industrial companies releasing earnings this week. 3M, GE, people like that. Bloomberg Opinion, a columnist who covers the industrials, Brooke Sutherland. She's going to join us here in studio to break it all down and see what we can see from corporate America. Then Ann Maletti, one of the all-time favorites here at Bloomberg. She's with Allsprings, head of active equity. She's going to join us via Zoom to talk about these markets. She's got some perspective. She's got some experience. So we'll tap into that, Ann Maletti, coming up in just moments. But first, let's go to John Tucker and get a Bloomberg Business Flash. John.
All right, thanks, Paul and Madison. Right now, the major averages, they are all in the green. Earnings in the driver's seat this week. We get a batch of earnings reports from mega cap growth and tech companies. You have Alphabet and Microsoft. They're going to report their numbers tomorrow. Meta on Wednesday. Meantime, Ben Laidler at eToro says stocks are in a bit of a no man's land this week.
You know, the Fed and the ECB, peaking, giving a bit of visibility. There's not very much further to go. If anything, I think we'll keep valuations high. And we have, north of 40% of the S&P 500 reporting this week. I think the baton is now passing from valuations, where you've made all your money this year, to earnings.
Right now, the S&P 500, 18 points higher. That's up 0.4%. We're at 45.54 in the index. The Dow Jones Industrial Average up 188 points. That's up 0.5%. NASDAQ 100, 18 points higher, up 0.1%. United Parcel Service and the Teamsters negotiators, they're poised to restart talks tomorrow as the two sides seek an agreement before the current labor contract expires at the end of this month. And Domino's Pizza failing to deliver. Sorry about that. They're reporting second quarter earnings that fell short of estimates. To me, Domino's is like pouring marinara sauce on wet cardboard.
Yeah.
But that's just one man's
John, that is a very biased report.
I'd say it's geographically
and
biased.
what's your point?
Journalism is
Well,
my
if
point,
sorry.
John.
Okay,
Well, if you're in this part of the country, you get the best pizza.
Oh,
in this
yeah.
part of the country.
There's
But
no real-
in the rest of the country, maybe excluding Chicago a little bit, they don't have access to real pizza.
Right.
So Domino's is it, right?
I guess.
I mean, having
it's-
gone to school in Virginia and North Carolina, Domino's is kind of where you rely upon.
Plus, now you can get it delivered via Uber.
Well,
Uber Eats.
I would say with the
I don't think
legalization of
Uber Eats.
marijuana in many districts,
Yes.
that's sort of like a munchie play,
Yeah.
Domino's, for
Sure.
stock investors.
I'm
A
sure.
good
The
convergence
lava
there.
cake and all that.
All that.
All right.
stuff.
Too bad for our good
Anyway,
friends at Domino's.
that's your markets update.
All right, John, thank you so much. We
Connection
appreciate
lost.
that. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. Of course, we are now streaming live on YouTube. Just head over to YouTube and search Bloomberg Global News. We got some nice green on the screen here today, some movement. We got some anticipation of some earnings. We had some PMI data, lots for the markets to chew on. Alex Semenova joins us. She covers all the markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at today?
Well, we have to talk about movie theater and entertainment stocks after the opening weekend for Barbie and Oppenheimer. One company that stands out to me today is Cinemark. Shares are up a little bit more than 1%, so not the biggest move there, but what is interesting is it is getting a lot of analyst praise today. As you said earlier, Paul B. Riley securities analyst Eric Wald noted that he was impressed by the fact that a non-sequel title could drive so many people into theaters. That was a very
That's
reassuring
important. Yep.
sign, in addition to the fact that we are seeing a return in demand for theater going after the pandemic. There was also a really interesting Bloomberg intelligence report out on the terminal. They point out that its healthy balance sheet has been a key differentiator compared to some of the other theaters that have experienced, that have struggled from the 2020 pandemic shutdown. lockdowns, and it sees it more favorable than some of its larger peers. It says that it's going to experience a return to positive annual free cash generation, and it also has some room to increase ticket prices, although it doesn't see a full recovery for the company until 2025.
Yeah, it's interesting. People are, I think Hollywood's still trying to figure out where, the theatrical window release resides within this whole thing of getting paid for your content. But there's a story going around that Steven Spielberg went up to Tom Cruise right after the Top Gun sequel came out and said, "Thank you, you saved Hollywood. You saved the movie-going business," because it proved that post-pandemic, people will go to see something they really want to see.
Well, I hope that Spielberg sends a handwritten note to Greta Gerwig as well, because
exactly.
This movie had a better opening weekend than Top Gun, if I'm remembering that correctly. Interesting, too, on the pre-pandemic movie-going numbers, we're still lagging by about 20% when it comes to domestic receipts, but up 16% so far this year. Alex, how is this impacting Warner Brothers today?
So Warner Brothers is also up more than 1% after the strong opening weekend. Another name that is moving is IMAX. Shares were up about 6% the last time I looked at my terminal. So just a favorable day overall. They're riding some of that green market movement today, and just analysts are reacting really positively. Pink. Analysts are reacting positively to this.
All right, what else are you looking at here in mostly up there across across the markets?
So I want to talk a little bit big picture about big tech and the incredible concentration we've seen this year with the NASDAQ 100 up more than 40% year to date. There is this big cloud over tech this week with earnings out from some of the big names like Apple, Microsoft, Meta this week. And that bar is very high given the big moves in the companies that we've seen. However, what investors are going to be looking at is what these companies are saying when it comes to their AI breakthroughs. Wall Street is treating AI with a little bit more scrutiny. JP Morgan strategist had a really interesting note. They see a reversion. They see the equal weight S&P 500 outperforming the cap-weighted index after the run this year. And they said that one interesting thing that will happen is that investors are going to be handling AI a little bit more rationally than this initial frenzy. So that's something that we're going to watch in those earnings results. They actually have to deliver and have something to show for all of the mentions of AI that we've heard all year long.
Yeah, we were talking to Dan Ives about that earlier today, and obviously he was very bullish on everything tech, but it'll be interesting to see how happy he is this week. I know we talked about this a little bit earlier, Alex, but just want to go back to Zoom this week. Are we anticipating this
now,
kind of...
Zoom, the video conferencing thing?
Yes.
Okay,
yes,
ZM
right?
is your symbol.
Yes.
Okay.
So are they, kind of a pandemic stock, are they still going to be succeeding a couple years out of the pandemic?
We will have to see. It's a tough environment for them. All these post-pandemic stocks, all these pandemic stocks aren't doing so well in this post-pandemic world where people are, back to in-person meetings rather than Zoom meetings. It did get a downgrade today from RBC, flagging concerns over AI and competition for the software company. Also getting a downgrade to sector perform. Of course, it has mentioned AI to try to make up for, some of the market value that it's lost as it struggles,
Yeah, my pandemic stock is Peloton.
Oh yeah, you're a big Peloton guy.
There's some crazy people out there on the Peloton. It's a big time cult, but they have some passionate users out there. But it had a peak price back in February of 2023 of like 100. No, I take that back. They went way back. It got well up in. I'm going back. The peak price for this stock was $160, $167 a share back in January of 2021. Stock's under $9 right now, but it is up 12% year to date. But 160 to 9. That is a pandemic stock.
It is always incredible to compare the charts on these companies because they all look so similar. You see this incredible rise and then the downturn, and they are rebounding a little bit this year, but they're very unlikely to get back to those levels.
Right. And pre-pandemic, Peloton was trading around $20 a share.
Right.
So, it's 20 to 160. Where's a fair value for this thing? Since then, they've undergone a tremendous amount of managerial change, strategic change, all kinds of things. So we'll have to see how that plays out. But that is my, pandemic stock.
You know what I always look at with Peloton is how many of them are listed on Facebook Marketplace. To me, that is the driving indicator of where that stock is heading.
I've also seen some of their gear selling in places like TJ Maxx, which I don't think are a very good sign.
Not
for
a
the
good sign
future.
when Alex and I pop over to the TJ Maxx on 58th and see Peloton.
Get a Peloton. All right, Alex, thanks so much for joining us. Alex
Thank you,
Savanova,
guys.
Bloomberg Markets reporter, joining us here talking about these markets. And again, we got a pretty strong market moving right now. Let's talk about some of the industrial companies, and because they're reporting numbers today. But I looked at the PMIs today for and the manufacturing PMI came in at 46.2. That's not good on the number fronts. It's below 50, suggesting contraction, and it was below the consensus of 49, and it was below, just kind of in line with last month, 46.3. But I want to start there, and then we'll branch out to some of the manufacturing companies that are reporting later this week. Brooke Sutherland joins us. She covers all of that industrial stuff for Bloomberg Opinion, and she joins us here in our Bloomberg Interactive Broker studio. So, Brooke, what did you think when you saw the manufacturing PMI today? It's a manufacturing recession. Is that kind of what we're dealing with?
I mean, this is a continuation of a trend where we have seen, numbers from the PMI that have been indicating a contraction in manufacturing activity. I think the question is, there's a bit of a divergence between those numbers and what we're hearing from the industrial companies, which are still very bullish on the demand that they're seeing. They, are talking a lot about sort of structural tailwinds that will keep people buying industrial equipment for the foreseeable future. Those include electrification of everything, the sort of wave of factory investments that we've seen in semiconductors, electric vehicle, and other types of manufacturing. And I think the question for investors is, whether this slowdown that we're seeing just reflects a normalization of supply chains, because you had a lot of people that were over-ordering just to get their place in line, and to make sure that they could get some kind of components coming in the door, and whether we may be seeing the other end of that, or if we're seeing a real demand slowdown. And I don't think investors have made up their minds, and I think it depends on which company is reporting, honestly, the way in which people view their orders numbers.
It feels like 3M is the name to watch this week. Is that what you would say?
Sure. I mean, it depends on what you're looking for. We've got just about every industrial company reporting earnings this week. So 3M is interesting. I don't really view them. They used to be an industrial bellwether. I don't really think of them as that anymore, just because they have so many idiosyncratic problems, including PFAS liabilities. They have an ongoing legal issue with combat earplugs that they sold to the U.S. military that veterans are claiming were defective. And so, they have a variety of issues that, investors will be looking for updates on, but they do still have their industrial businesses. And it will be interesting to see what's happening there. These tend to be early cycle businesses, and so they tend to be on the front lines of economic swings. So if we are seeing a slowdown, you would see it hit there first before some of the longer cycle businesses like aircraft engines or wind turbines or things like that.
This is a Tom Keene kind of trivia question. What does 3M stand for?
I don't know that.
Minnesota Mining and Manufacturing. John Tucker knows that.
Yeah. Well, it used to be. They officially changed the name
to 3M.
To 3M.
Yeah, but they're based in St. Paul, Minnesota. St. Paul's a great town, by the way. I love St. Paul. Great hotel there. I can't think of the name. But the stock has been brutal, trailing, over the last 5 years, compounded annual decline of about 9% versus the S&P 500 up almost 12%. So that's just a brutal name. And what's this? I mean, it's a $58 billion market cap company. What's the problem with those guys? What's the story?
You have to somewhat feel bad for the current management team, because the issues largely do not have to do with decisions that they made. They have to do with the way in which 3M was managed, decades ago. So the company is a legacy manufacturer of PFAS, which are known as forever chemicals because they linger in the environment and in the body. They've faced numerous legal challenges over PFAS, and the uncertainty of what happens there has been a big drag on the stock. And then, as I mentioned, there's also the military earplugs issue, which was the last thing that the company needed, but remains unresolved. And we're talking about estimates in the range of several $1 billion to try to settle that alone before you even start talking about PFAS.
All right. 3M, Minnesota Mining Manufacturing, went public. Just some trivia. You can get on the Bloomberg terminal with the DES function. October 1st, 1978. Who took them public? Kidder Peabody, which was an awesome firm back in the day. Some of the best bankers, best analysts, great M&A practice, really good stuff. All right, GE. I kind of still consider them a bellwether. I don't know. They're not the bellwether they used to be. What are you looking for here from GE? What are investors going to be looking for?
Sure. I mean, well, they're a significantly simpler company than they used to be from back in the Kidder Peabody days. But so they've already spun off their healthcare business, and then they are speeding toward eventually spinning off their energy businesses. And so that includes their gas turbines, but also their wind turbine business and some other myriad assets that get kind of grouped with that. And once they're done with that, they will essentially be an aviation company. And investors are already treating the stock as if, that spinoff is a done deal. And I think it's just a simpler story, and people are better able to focus on that core aerospace business and the growth opportunities there.
Brooke, one of the fantastic stories that you have for us on Bloomberg Opinion recently is about ties to China for some of these names. And you specifically talk about Chinese ownership of Cirrus Aircraft, I believe. Can you talk to me about how the China story is impacting some of the names that you cover?
Sure. I mean, I think it is a big issue, and I think the current environment is a minefield for CEOs, even those who have had long-standing relationships with Chinese entities. And so Cirrus makes private planes. These are more like hobby aircraft or used for charter flights, that sort of thing. And they were acquired by a subsidiary of a Chinese company in 2011. Before that, they were owned by a Bahrain investment arm of a bank there. And so they've been under foreign control for a very long time, but the company is getting more scrutiny. It filed to go public in Hong Kong in June, and that's just drawing attention to the fact that it is, in fact, owned by a subsidiary of a Chinese entity that is subject to sanctions. And you're seeing this happen in all types of industrial businesses where, long-standing relationships are coming under fresh scrutiny. There was also a report in the Wall Street Journal earlier this year about a Rockwell Automation software development center in China and whether that might pose some sort of national security risk. And I really think to operate in China, if you were an industrial company, you need to have a siloed enterprise there. And a number of companies have already taken efforts to set this up. Emerson sources 96% of its components for its Chinese products within that region, with the rest coming from other East Asian countries. It doesn't run that business with expats. It uses all local employees primarily. And I think you're just going to see more and more of that.
So when you talk to the industrial companies that you do all the time about China, is it central to their future as either a source of raw materials or an end market for consumers? How do they view China over the next 5 to 10 years?
Sure. I mean, I think they're carefully, just given what a political issue it is, but it's a very important market for these companies. It's the reason why they're there in the first place. And so, one of the interesting things about Cirrus, the private aircraft maker, is that, the entity that owns it has joint ventures with just about every aerospace company under the sun, and most of them are focused on the development of the C919, which is the COMAC challenger to the Boeing 737 MAX and the Airbus A320. And the reason why those U.S. companies have those ventures is because they want to compete for this business. That, if this is sort of the future of China aviation, it's an important place for these companies to be.
All right, Brooke, great stuff as always. Brooke Sutherland, she's a columnist covering industrials and deals for Bloomberg Opinion. Appreciate getting a few minutes of her time. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, shares of AMC Entertainment are up more than 26% after a Delaware judge on Friday blocked the company from converting its controversial APE preferred units into common stock. Bloomberg's Abigail Doolittle has more.
So now this new settlement that both the company and the investors have proposed, it releases those preferred shareholders in case they do want to litigate in the future. But it also may bring the settlement down to about $100 million.
Thanks, Abigail. Experts say it looks like the company will be able to raise that capital. Johnson & Johnson is splitting off shares of its former consumer health business. Bloomberg's Gina Cervetti reports.
The pharmaceutical giant says the separation of at least 80.1% of its shares of Kenvue will sharpen J&J's focus on its pharmaceutical and medical technology businesses. Shareholders can exchange shares of J&J common stock for shares of Kenvue stock at a 7% discount. Kenvue listed independently in May via an exchange offer. Steve?
Thanks, Gina. Shares of Johnson & Johnson up now more than 1.3%. Elon Musk has changed Twitter's logo, replacing the bluebird with a stylized X. It's in an effort to transform the social media platform into what he says is an everything app. CEO Linda Yaccarino says X will include payments and banking alongside audio, video, and messaging. And Domino's says it will lean on its deal with Uber and its revamped loyalty program to boost sales. The company's delivery business has been struggling. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney coming up right after this.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This week's going to be the busiest for earnings of the season. 40% of the S&P 500 reporting is going to be headlined by Microsoft, Alphabet, and Amazon.com. So far, the S&P 500 on track to modestly beat earnings per share estimates. Revenues also edging out expectations, although only a fifth of the companies have reported so far. On the economic front, U.S. business activity expanding in early July at the slowest pace in 5 months, yet services growth moderating. Investors going to be watching to see if a slowing economic momentum shows up on the profit margins. The NASDAQ special rebalancing that took place today. Goldman Sachs strategists say it's unlikely to solve the problem of high market concentration for now. S&P 500 right now 22 points higher. That's up 0.5%. We're at 45.58 on the index. The Dow Jones Industrial Average is up 201 points, and that is a rise of 0.6%. The NASDAQ 100, 41 points higher. That is up 0.3% at 15,465. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Maddie and Paul.
All right, John Tucker, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio. You know, I was looking at GE stock. We were just talking Brooks Sutherland. Over the past couple of years, it's up 19% on a compounded annual basis versus the S&P 3%. So as Brooke was saying, they're slimming down the company, trying to make it easier to focus on, easier to value, trying to focus on some of their better growth stories like they're, making the jet engines and all that kind of stuff, their aircraft business. It seems to be paying off with the stock. They're finally getting a little bit of love here. And I mean, you think about GE, it was corporate America for such a long period of time. It's a lot smaller now. It's got a market cap still $120 billion, but it used to be back in the day into pretty much everything. And financial services became probably one of the biggest parts of the entire company. And then with the great financial crisis, people said, that's not such a great decision.
Right, right. Well, it's interesting, too, that you bring up airfare as well, Paul, because we've got Ryanair reporting today, first quarter profit after tax coming in a little bit higher than anticipated, but the stock still in the red today, not beating estimates by enough to really drive that stock forward. And just as a reminder to folks, this is kind of one of those accessible lower fare passenger airline services getting folks to Europe from the States and around the globe as well, and reaching about 3,000 daily flights over 240 destinations. So more of an economic indicator than anything else when it comes to sales and that stock in particular. Having said that, we're still heading into the rest of the earnings cycle. We got to get some more of these consumer names in to indicate to us how consumer spending is holding up in the midst of the record-breaking inflation that we've got going on. One of the stocks that we talked about earlier today on that story, Domino's, really leaning in on that Uber deal, those third-party partnerships when it comes to the Domino's story, to just kind of indicate that they have a lot of growth coming in and they're willing to dig deep on those third-party partnerships to continue that growth. But as JT told us, Domino's not a big fan.
Yeah, I don't know. Yeah,
I mean, well, have you had it?
I mean, we were all in
right.
college,
You have the greatest pizza in the world. Why
you know
would
what
you
I
go to
mean?
Domino's?
Right, but if you're in other parts of the world, it is a
There are
godsend.
other locations, JT. That's the issue.
Yeah, exactly.
There are other cities.
Oh, but they closed Domino's too in that earnings report. I think there were like 56 nationwide that shut down.
Yeah.
I don't know why, but
all right. Well, you know, it's
maybe people
because
are
of you.
smart.
Yeah, your review. All right, let's check in with somebody who really does this stock stuff for a living. She's been doing it for a while now. She's got some experience. Ann Maletti, head of active equity at Allspring Global Investments in what town? Milwaukee.
Milwaukee
Another
again.
one. I'm telling you, it's my theme here.
Nice.
And thanks so much for joining us here. We're getting into the teeth of the earnings cycle here. What have you seen and heard so far, and what are you looking forward to going forward? It's a big tech week of earnings.
It has been a big tech week. Nice to talk to you again, Paul. Look, so far earnings for the most part have been pretty strong, but I think what our teams are looking at is what does the tail end of earnings season look like? And I think we'll see some volatility this earnings season. I think that was somewhat expected by most investors. You do generally see some softness this quarter, and that's what we're expecting to see. But, you know, from what we expected all year, there will be differences from the bottom up, company by company. And that's why we think it's a great environment to look at companies specifically and not just, you know, pick a sector, pick an industry, pick growth, pick value. It's time for individual company selection right now.
So, Ann, what is the market going to move on more this week? The Fed decision or some of these tech earnings?
That is that's a great question. I do think it's not going to be on the Fed decision itself. I think we all really do believe, and there's kind of a consensus opinion that we're going to get that 25 basis point increase. But I do think what we don't know is if we're going to get the interpretation of a hawkish tone or a dovish tone from Chairman Powell. And that is the million-dollar question out there. I guess I'm in the camp that he's still going to continue to be a little bit more hawkish. And, you know, even though we have seen some signs of weakness in the economy, the jobs data and the employment data continues to be pretty strong. And that's going to continue to make him fairly cautious and want to give him optionality that we may not be done, or that the Fed may not be done raising rates. And so I think the market's going to move a little bit more on that than on tech earnings.
Hey, and you and I have known each other for a while, so it will not surprise you to know that I missed out on owning those big magnificent seven names. So now I got some work to do for the remainder of the year. Do I look at maybe some smaller mid-cap names? I mean, that requires a little bit more homework on my part, but is that where you think some opportunities might be?
Paul, you probably put me in the same camp. I do think there is a really good opportunity for investors out there. And, I think this is something that we've been focused on a lot, because for investors who want to invest more broadly, who want to stay in the market, regardless of what the economy is doing. And by the way, history would suggest that is the right thing to do. If the market broadens out, and it should, there are real opportunities down cap. And if you just look at the fundamentals, what Paul, you spent a lot of time doing, and I spent a lot of my career doing, free cash flow is a really good metric of quality. And if you look at the free cash flow margins and the highest quintile of free cash flow margins in those smaller cap names, they're trading at a 20% discount to the counterparties in large cap. And that's a historic discount by any measure. And, you know, if you can buy quality at that big of a discount, and even at a discount relative to their smaller cap peers, that's the area of the market that our investment teams are finding some real value in today. And I think where investors can be rewarded. There's strong balance sheets. There's, you know, that free cash flow will give them protection, even if things get a little bit more challenging in the economy, even if we head into a recession.
So, Anne, how much of the boat needs to be filled with small caps at this point, given what you're saying about some of the opportunities there?
You know, the allocation decision is really a personal one, and that's where it's a little bit more challenging for me to have a personal opinion. I certainly do have an opinion of my own, but I think for investors, small cap can be a little bit riskier. But again, it's the area, it's just where you want to invest within small cap. I don't think it's an area that should be ignored. Growth can continue to be really good in small cap companies, even when growth pulls back within the economy. So it's an area that investors should not ignore, but I'll leave the allocation decision up to investors themselves. The tactical decision is, I would just say, don't ignore the area at all.
Hey, and do you folks at Allspring, are you still talking recession? Is that still in your outlook, or have you kind of tabled that a little bit?
Yeah, you know, I think we're still in the camp that the recession risks still do linger. And the reason for it is 6 months ago, you know, we were only at 3% interest rate. And there's a lot of rate increases that have happened since then. And there's a big lag effect to the impact of increasing rates. We have yet to see the full impact, whether that takes 6 or 9 months to fully feel that, you know, we haven't seen it. And so we're still cautious about how bad the total impact will be. We already know we saw, you know, some breakage in the system with what happened with the regional banks earlier. I don't completely think that it's over. And again, we're not done with rate increases. We have one coming this week, and then still a question about what happens after that. So it's not off the table for us. That being said, you don't want to be out of the market completely. We already saw the ramifications of what could happen with that. And so, you know, the economy and the market are two different things, and investors just have to keep that in mind.
All right, Ann, thanks once again for joining us. Ann Maletti, head of active equity at Allspring Global Investments, based in that financial powerhouse known as Milwaukee, Wisconsin. And I mean that when I say it. Some smart folks there. I've encountered over my career. Looking at the S&P 500 up 0.4%. The Dow up about 0.6%, 200 points, even 35,400 on your Dow. And we are solidly above 14,000 on the NASDAQ. NASDAQ up about 0.1% today. Right now, let's head down to Washington, D.C., get world and national news with Nathan Hager.
Paul Sweeney, a judicial reform law that has divided Israel, has passed that country's parliament, and that division was on full display for today's vote. Opposition lawmakers shouted shame as they walked out of the Knesset ahead of the vote, allowing Prime Minister Benjamin Netanyahu's ruling coalition to pass the measure 64-0. The law would weaken judges' ability to override government decisions and appointments. Opponents fear it will weaken rule of law in Israel and the country's economy. North Korea may have fired another ballistic missile off its east coast. We got that word from South Korea's military as the U.S. sends major naval assets to South Korea as a show of force. The UN has also begun talks with the North Korean military on the fate of Travis King, the 23-year-old Army private first class who crossed the border from the South nearly a week ago. Florida Governor Ron DeSantis is facing more heat over how the history of slavery will be taught in his state. The school board in Florida just approved a new K-12 curriculum that would teach that slaves developed skills that could be applied for their personal benefit. Rashad Robinson is the president of Color of Change.
What they're trying to do is not just whitewash the curriculum, take away the sort of truth about Black history and the truth about white history and the truth about American history as a project to essentially make folks dumber about what we need to do in this country moving forward.
Rashad Robinson with Color of Change. Governor DeSantis has said he was not involved in the school board's decision and it was not political. Vaccine politics may have led to more excess deaths during the pandemic. That's according to research from Yale published in the journal JAMA Internal Medicine. It found Republicans in Ohio and Florida had a 7.7% higher rate of excess deaths than Democrats in the months after vaccines became available. The study did not directly attribute those deaths to COVID. This is Bloomberg.
tickets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it's a jam-packed week of earnings and the Federal Reserve's rate decision on Wednesday. From the Bloomberg Newsroom, I'm John Tucker with this Bloomberg Business Flash. Ahead of all that, the major indexes right now are higher for the most part. The NASDAQ 100 just back in the red. Remember, this is the first day of the rebalancing. Globally, companies with a combined $27 trillion in market value open their books. They're going to include Microsoft, Alphabet, and Amazon. And at almost 20 times forward earnings, the S&P 500 trading at a premium to its long-term price valuation. And as the Fed meets this week, economist Kathy Bostjanik at Nationwide says the labor market continues to be a thorn in the side of policymakers.
We're overemployed, which, sounds great, right, if you're an employee, but problematic for the Federal Reserve, right, as they try to balance that against inflation pressures, and also for corporations had trouble still finding qualified worker and fueling that wage pressure all during this period.
And U.S. business activity expanded in early July at the slowest pace in 5 months as services growth moderated. Again, that's the biggest part of the U.S. economy. S&P 500 right now up 17 points. That's up 0.4%. Dow Jones Industrial Average 197 points higher. That's up 0.6%. The NASDAQ 100 now down 9 points. Meta Platforms, one of the biggest drags in that index right now. And we check the markets for you all day long right here on Bloomberg. You know, Paul, there's a rule in this studio.
Yes.
No drinking of liquids.
That's what I've heard.
You can spill them and, gets all over the very, very expensive equipment.
Yeah, that's
I'm
what I
not
understand.
mentioning any Madison names.
No.
You know what? Every single one of us has a drink right now.
I
I'm
don't
just
have a
the
drink.
idiot that spilled
I
it.
wish I had a drink. Not coffee either.
We'll have this cocktail later on. Don't worry
Sorry,
about him.
JT. It was all that anti-Dominoes talk that you had earlier just got me going.
I just threw you under the bus. I'm sorry.
I'll
Anthony
take
from
it.
Sparta's not listening. Don't worry about it. All right, let's go to Mattel here. This is a beneficiary. They own the whole Barbie thing. Mattel stock is up 1.6% today. Nice move. It's up 20% year to date. That's nice. It's got a market cap of $7.6 billion. Let's break it down with the analyst at Bloomberg Intelligence who covers Mattel, the company, the stock, Lindsay Dutch. She is an analyst at Bloomberg Intelligence. So, Lindsay, give us a sense of kind of what this means for Mattel here. It's obviously a great day, a great weekend for the movie and what it means. But what's it really mean for the company?
Yeah, thanks, Paul, for having me. This movie is a big deal for Mattel. Barbie is one of their biggest brands. It peaked at $1.7 billion in 2021. It was off about 11% last year. There was sort of weak demand for Barbie. So coming into this movie, there was a lot of uncertainty, and concerns about demand for the dolls. But I think Mattel did a really great job in terms of hyping up the movie. And I think that could be a catalyst for the second half and really a rebound for the company in terms of toy sales, but also the royalties that they're going to get from the movie and related merchandise and things like that. So there's a real possibility of strength in the second half, with this big movie debut.
Lindsay, I'm curious about, and I know you haven't seen the movie, but there's definitely a sense of Mattel calling themselves out a little bit when it comes to some of the potential, what some would view as mistakes they've made in terms of Barbie's impact on how young women and girls are viewing themselves, et cetera. I wonder, is there any potential negative impact for Mattel because of some of those messages, or is the extreme success of the Barbie movie just going to be a boon for them?
So I agree. I mean, I think that the brand has had ups and downs, throughout its sort of life and creation. I think Mattel was going into this movie. They knew it was critical to, reinvent the brand a little bit and sort of ease some of those concerns that we've had. So I think that was, it is a pivotal a pivotal moment for the company and whether they can really, change the attitude around Barbie. But there are also so many people who are nostalgic about the toy, about the brand, and that adult collectors market is huge and it's growing. It's a big piece of the toy market. And so I think that there's a lot more opportunity than risk, especially like seeing the numbers coming out of this weekend and this debut.
Lindsay, talk to us about the toy market in general. How big is it, the toy market in general? How big is it? What's the growth characteristics of kind of the toy business? Because now it seems like every kid's got a phone in their hand.
I know. So, the toy market, in terms of dolls, if you think about dolls, that's more like a $3 to $4 billion category. Mattel is a clear leader. They've always been a dominator in that doll category because of Barbie. They also own American Girl. When we think about dolls, growth was astronomical in the pandemic, and it really started to come off in 2022. There was weak demand. We had over inventory issues, for a lot of their key suppliers, if you think about Target and Walmart. So there was a huge pullback in the fourth quarter last year, really hurt results for Mattel and as well as other peers. And the beginning of this year, it is going to be challenging. Their sales were down in the first quarter. I'm expecting sales to be down again when they report their results for the second quarter. But like I said, this is really a second half story for the company and really what can happen with this growth going into the back half. So in terms of the category as a whole, you're talking about sort of like low to mid single digits growth, in this next couple of years. Mattel is typically a market share gainer. So, we would typically expect a little bit faster growth coming out of Mattel.
Well, and you mentioned American Girl. They've also got Hot Wheels under the Mattel brand, which has increasingly been taking up a bigger piece of the revenue pie. Do you anticipate that allocation changing this coming earnings season or earnings results because of the Barbie movie?
So I think Barbie has always dominated in terms of Mattel's revenue mix. You're right. Hot Wheels is gaining. They were about a $1.25 billion business last year compared to Barbie's 1.5. I think that, heading into second half, success of the movie could really put Barbie back, sort of on top. I think Hot Wheels is sort of closing that gap here in the first half. I think Mattel's history does sort of, skew towards that doll category, but the vehicles has just had a couple of really great years. And when we saw growth slow in dolls, vehicles picked up. Also, action figures has been a really big growth driver for them. It's much a smaller business, but we are seeing growth in that category. But I do think coming into the end of this year, we'll see Barbie still be a bigger business for Mattel than Hot Wheels, but that gap is definitely a lot tighter than it was historically.
All right, Lindsay, as a former media analyst myself, I have to ask this question. Is there going to be a Barbie sequel? What have we heard from the company? Have they said anything?
They have not said anything, but their CEO has a background in TV and entertainment, and I think he truly believes in sort of that halo effect, linking entertainment and movies and everything that we stream today, to physical toys. So I wouldn't be shocked.
And the return on the investment in the Barbie movie is going to be considered a positive for them when history looks back on this moment, right?
Yeah, so I think there's, some element of the movie baked into guidance, which is pretty bleak for the year when we think about Mattel. But I think a lot of it is not baked in. I think, the profitability, the margin on, when they license out that Barbie brand, the pink bee, they had, a partnership with Gap that they did, all that merchandise sales, all the licensing out of things like that, it is huge on the margin. And I think that a lot of that stuff can come in better than expected this year. But again, sort of just rebuilding that love of Barbie and the brand going forward.
All right, Lindsay, thanks so much. much for joining us. Lindsay Dutch, she's an analyst at Bloomberg Intelligence. She covers some of the consumer space, retail, as well as the REITs. But today it is all about her coverage of the company Mattel. Again, a stock up nice today on the news, up 20% year to date. See if they can monetize this Barbie mania going forward. This is Bloomberg. All right, let's get some company news right now. Steve Rappaport.
Shipments steady, asking suppliers to produce about 85 million units of the iPhone 15 this year. Bloomberg Intelligence analyst Mandeep Singh.
Clearly, I think this calms down the nerves in terms of Apple really seeing a big decline with their new launch. But, flat shipment isn't very encouraging, although I would say you will see ASP growth with any new Apple product launch.
Thanks, Mandeep. Shares of Apple are up less than 1%. Shares of AMC are higher, too, up more than 28% after a Delaware judge on Friday blocked the company from converting its controversial APE preferred units into common stock. Chevron posted better than expected earnings, but the biggest news for the company may have come on the management front. Bloomberg's Simone Foxman explains.
Will retire in 2024. He's been CFO since 2019. He will be replaced by the current CTO, Emmer Bonner, who will take over on March 1st. Also waiving the retirement age for the CEO, Mike Wirth. He's 63. The current mandatory retirement age is 65, so it looks like he'll be around for a little bit longer.
Thanks, Simone. Shares of Chevron up more than 3%. And David's Bridal gets hitched today to a new owner, Scion Investment. 195 stores will remain open on the $20 million Scion has invested in the business. Bank of America will also continue to provide funding with a revolving credit line of $50 million. The move will save some 7,000 jobs. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney coming up right after this, right here on Bloomberg Radio.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio. Looking at this market, a nice start to the week here. S&P 500 up about 0.5%. NASDAQ lagging a little bit, up 0.2%. I want to call out WTI crude oil yet again. It's up about 2.5%, just under $79 per barrel. So a big move. Again, about a year ago, we were under $68 a barrel, so a big move there for oil, presumably on higher demand. The VIX for the stock market sitting below 14, 13.79 for your VIX, so not a lot of volatility out there for traders. Right now, let's head down to Washington, D.C. We'll get World, the national news.
Paul, Israel has passed its controversial judicial overhaul law, and protesters are back out. Thousands gathered outside the Knesset, where lawmakers approved the measure to weaken Israel's judiciary by a vote of 64-0. The 56 lawmakers in opposition to Prime Minister Benjamin Netanyahu's government walked out in protest. This student's outside trying to make her voice heard.
We were left with no choice but to go to nonviolent disobedience. And we're here to protect our democracy.
President Biden had issued a late statement to Axios last night urging Netanyahu to delay the vote. The prime minister was in the Knesset for today's debate after getting a pacemaker over the weekend. North Korea has fired at least one ballistic missile today. That's according to the South Korean military. If confirmed, it would extend a streak of weapons tests in apparent protest of the U.S. sending naval assets to the south. The reported launch came hours after the nuclear-powered USS Annapolis docked at South Korea's Jeju Island. Last week, the USS Kentucky became the first nuclear-armed American sub to dock in the South since the 1980s. On Capitol Hill, House Republican leaders are still haggling over spending bills, not with Democrats, but with each other. Bloomberg's Amy Morris reports from Washington.
Leaders will have to continue talks with conservatives within their own party, with amendments aiming to cut more funding from the agriculture FDA bill or add policy riders. There are measures to block funds for puberty blockers for minors, hospital systems that provide gender-affirming care for minors, the development of any COVID-19 vaccine, and aid to Ukraine. And Republican Senator Lindsey Graham of South Carolina predicted a months-long continuing resolution paired with an emergency supplemental spending bill. In Washington, I'm Amy Morris, Bloomberg Radio.
We've been talking all day about Twitter's new X logo. Well, this story might have you saying Excelsior, a batch of more than 8,000 non-fungible tokens of the late Marvel editor-at-large Stan Lee sold out nearly instantaneously today. That's according to Cartoon Studios, which rolled out the $15 NFTs to mark what would have been Stan Lee's 100th birthday. He is best known for creating Spider-Man, The Incredible Hulk, Iron Man, all those Marvel movie cameos, and that Excelsior catchphrase. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg. Paul and Madison.
All right, Nathan, thanks so much for that. We appreciate it. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio. Madison, what's going on in Austin, Texas?
Yeah, really interesting. So Austin was leading the return to the office earlier on in the post-pandemic era and earlier in this year as well, kind of leading that return. Now we're seeing that they're actually one of the laggards nationally when it comes to the return to the office. And this is particularly because of the big tech expansion happening in Austin. We're seeing IBM, Apple with ambitious expansion plans in the area. And those are the types of companies where employees are saying, I'm not going to go into the office. I'm doing a hybrid vibe.
So the numbers are, its office occupancy rate fell from 68% in early March to 57% last week. That's the biggest drop by far among the 10 major U.S. cities tracked by security firm Castle Systems. So, and the office vacancy rate in Austin rose to 25% in the second quarter. That's according to Cushman in Wakefield. So, everybody, it's just, Austin's just one of those towns that, during the pandemic, everybody seemed to be going to Austin, Texas, or down in South Florida. But now they get there and they're like, wait a minute. The rest of the world's not going back to the office.
Yeah.
Why do we?
Yeah, of the 53 companies that left California in the first half of 2021, 1 in 5 went to Austin.
Okay. Hey, it's a great town.
Yeah.
Great football team down there. I love Austin. Yeah, awesome. Great Capitol building, too, the Dome.
Oh, yeah.
Excellent. Good stuff in the state of Texas. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Mark Gurman. He's the chief correspondent for all things technology. He is the Apple guru. He breaks most of the Apple news on the tape, so we're going to check in with him on what's happening with our good friends at Apple and any other tech story he wants to bring about, because he is based out there in San Francisco. He's got his ear to the ground. He knows it all. Plus, Peter Anderson, CIO at Anderson Capital Management, he's going to join us to give us his market call as we plow through these earnings. And then Fernando Valle, he's the senior analyst of Bloomberg Intelligence covering the global energy space. Chevron reported some numbers, so we'll talk about that. We want to just talk about where oil's going, because I've been calling it out here. And again, another big day up here in WTI crude oil. So we'll check with Fernando, see where this thing is going to go in the future. But first, let's check in and get a Bloomberg business flash here with Denise Pellegrini.
Yeah, we got a rally going on, Paul. It's 12:01 on Wall Street. We do check the markets for you all day long here at Bloomberg. Stocks are higher, and that's even after some signs of slowing growth, right? And ahead of this week's expected Fed rate hike, U.S. business activity, it expanded in early July. That's at the slowest pace in 5 months. Services growth moderated. The S&P Global Flash U.S. Composite Purchasing Managers Index, it fell 1.2% to 52 in July. Chris Williamson, S&P Global Market Intelligence Chief Business Economist.
I think the big takeaway from all of these PMI numbers today is the extent to which that growth driver that we had earlier in the year, the service sector, and especially the post-pandemic tailwind of spend on travel and tourism and so forth, is fading, and appears to be fading quite sharply, notably in Europe.
Yeah, and Williamson also pointing out, though, a reading above 50 is still positive. So there you go. The Dow up 198 points, up about 0.6%. The S&P 500 up 23. That's about 0.5%. The NASDAQ also higher, up 38. That's about 0.3%. Apple shares up more than 0.5%. Apple asking suppliers to produce about 85 million units of the iPhone 15 this year. That's roughly in line with the year before, according to sources. And the company is saying that it's likely to increase revenue overall because Apple is considering raising the price for Pro models. So get ready to pay more for those iPhones. And Domino's shares, they're up more than 2%. Domino's Pizza failing to deliver on quarterly sales, but still stock squeezing out a tiny gain. The 10-year right now, the yield on the 10-year, 3.8%. Spot gold, it is lower, down by about 2.78% at $19.59 an ounce. And crude oil, as you mentioned, a great day there. Crude oil up just about more than 2.5% right now, Paul. And we do have breaking news on Credit Suisse. Swiss Financial Market Supervisory Authority, FINMA, finding Credit Suisse seriously and systemically violated financial market law in the context of its business relationship with the Archegos, or Archegos, as some like to say, family office, and its legal successor, UBS. So there will be some repercussions there. That's a Bloomberg Business Flash.
What happened to my good friends at Credit Suisse? I used to work there.
I know, Paul.
Yeah, Denise, thank you so much. We appreciate it, Denise Pellegrini. Yeah, we, again, when it was Credit Suisse First Boston, back around 2000 to 2005, we were the bomb. We kicked some butt. We were very competitive against anybody out there. I don't know what happened.
You were in the glory days.
They were some pretty good. They were actually, the glory days were even before that, when it was just First Boston. Those guys were very, very, very good. Looking at the market here, we are pretty much at the highs of the day. S&P up 0.5%. Let's check in with Alex Semenova to see kind of what's happening out there under the hood. Alex covers all the markets for Bloomberg News, joins us here in our Bloomberg Interactive Broker studio. What are you looking at, Alex?
Well, guys, we got to talk about this very busy earnings week ahead. About 39% of the S&P 500 index is expected to deliver results. You have a little bit of everything on tap. You have Alphabet, Microsoft, Meta Platforms on the tech side. Then you also have names like Visa, General Electric, Verizon, Chipotle, giving investors a sense of how corporate America is holding up. up in the face of higher interest rates and inflation that still remains high. Some of the key themes that investors will be looking out for is demand in the second half of the year, capital expenditure, how companies are spending their money after overspending in 2021, and of course, artificial intelligence. Margins also will be a key theme here, which have so far shown some signs of improving. Now, when it comes to margins, there's a case being made among the bears that inflation is going to be a significant headwind for sales growth. Mike Wilson over at Morgan Stanley today said there's going to be a big shift from last earnings season when investors were cheering companies that showed signs of cost efficiency to instead of focus on top-line sales growth and how that's going to hold up if pricing power rolls over. On the other side, Bank of America Savita Subramanian today said that that's an old story. By their measures, goods represent 50% of S&P 500 earnings, and goods inflation has already fallen sharply from the first quarter of 2021. Unlike services inflation, which we know has been a bit stickier, core goods inflation has accelerated in the second quarter, so weakening price pressure may be easing for companies, and margins have been more correlated to core goods CPI rather than headline CPI. So all eyes are on margins, and as always, there's something for the bulls and something for the bears.
So all eyes are on margins, Alex, but so far when it comes to the earnings picture, I haven't been able to understand the market moves off of earnings necessarily. I feel like they haven't been directly correlated. So how are investors reacting to each earnings print we're getting?
Yeah, so it's still very early into the earnings season. We have a pretty small snapshot of what we've seen so far. But interestingly, stock investors have had a really weird reaction. So they're not really rewarding earnings beats. And some companies that delivered poor results, particularly insurers, have actually had a positive reaction. And there's a really good Bloomberg intelligence report out today. Bank of America also had a note on this, talking about how basically there has been so much optimism that the stock rally has kind of distorted the reaction. So investors already priced in the good news, and that's why we're seeing this mixed, strange reaction from traders.
I wonder how much earnings risk is really left in this market. Right now the S&P 500 analysts, you look at the earnings estimates, about $221 per share for 2023. Some strategists had been coming in all year saying that number could be $200 or even sub $200, and there's some numbers out there like that, but we just haven't seen it. I'm not sure we're going to see a big cut to estimates coming from this quarter's reports.
Yeah, I mean, everyone's looking forward to the rebound in the third quarter, so investors have probably already priced in some of those news, and the reaction might be very minimal when it comes to this earnings season. Everyone is kind of worried about an earnings recession, and it seems like the worst is behind us. It's very unlikely that we'll see any kind of substantial drop in earnings revisions.
And is there anything else, Alex, that your sources are telling you about what they are looking at when it comes to the second half of 2023 and what the big kind of market drivers are going to be?
Yeah, well, it's really all about the Fed. Obviously, earnings season is going to put some near-term pressure on this stock rally, but it really is about whether we'll get another interest rate hike and whether the Fed can engineer that soft landing that everyone is looking for. We've seen signs of optimism from inflation coming down across global economies. The soft landing scenario has been kind of driving the markets higher in recent weeks. Deutsche Bank is one of the firms that said that now a recession is actually a toss-up, where before they thought that the Fed would have to break something to get inflation down. So it all depends what Jay Powell says at his meeting, whether they signal that they are still considering another rate hike or whether this is the final one.
I wonder how much is built up in this NASDAQ. Again, the NASDAQ up, 33, 34% year to date. It's almost like these companies, these tech companies this week really better deliver some strong numbers. I don't think they have to be, obviously NVIDIA like from last quarter where they just reset the entire market, but they better at least handily match and or beat, I would think.
Yeah, the bar is incredibly high for these companies. As you said, Paul, an incredible run for the NASDAQ 100, up more than 40% this year. All of these names have been performing so well. There's very little room for error when it comes to what they report in their results. They're expected to be pretty solid, but again, it's going to be all about those earnings calls, what they're saying about AI. We've passed this initial euphoria where just the buzzword alone was enough to get investors excited, but now Wall Street is going to say, show me what you've got when it comes to what they report.
All right. Alex, thanks so much for joining us. Alex Semenova, some great reporting and just bringing us up to date on this market. Again, another good day in the S&P 500, up 0.5%, pretty much at or near the intraday highs. So holding on to those gains. Let's switch over to one of the names that's actually driving the performance this year, as it typically does, is our good friends out in Cupertino, Apple. Mark Gurman joins us. I don't know why, because he's a chief technology correspondent, something like that.
I liked CTO. He's basically the CTO.
Okay, we'll go with that. And he covers all the tech stuff out there in Silicon Valley. Mark, I haven't replaced my phone in I don't know how long, man. How does Apple think about me? I've had this phone for, I don't know, 3 or 4 years. What do they have to do to get me to kind of buy a new phone?
Yeah, so I think your first question is, what do they think of you? Okay, so they like you a little bit because you have an iPhone. They like you a little bit more if you're buying apps and subscribing to things, but they're not in love with you because you don't have a new one and you haven't bought for the last 3 or 4 years. What they would prefer is if you were upgrading annually. Yes. What do they have to get you? What do they have to do to get you to upgrade? Well, I'll just be completely honest with you because I've had similar thoughts as well. So the iPhone 10 came out in 2017. That's 6 years ago. So this is going to be, the iPhone 15 is going to be the 6th generation phone since the iPhone 10. God, honestly, it's not too different. The phone doesn't operate that differently, right? The big difference would be the overall performance in the speed. And the reason you would want to upgrade at this point is because the phone at this point, if you have an iPhone 10, probably feels really sluggish and it feels really behind, particularly on the camera. Or you've dropped the phone enough times, or you have dents in the steel band around the phone. You have a crack in your screen, or maybe you have a big glass crack or shattering on the back of the phone, right? So that's really how they get you to upgrade over time as the phone feels sluggish and damaged and such. This year is going to be an interesting year. This is going to be the first time in maybe 3 years where they're doing anything of significance, right, in my opinion. So the iPhone 15 Pro is going to be quite an upgrade this year. It's going to have a titanium case around the edges. That's instead of stainless steel. On the biggest and most expensive phone, the 15 Pro Max, it's going to have something called a periscope camera that allows for much deeper zoom using hardware. That means the camera lens can actually move within the phone to get closer to the image in order to provide better zoom versus the digital zoom we have today, which you can zoom in, but you get a bit of a blurry picture. They're also changing the charger to more of an industry standard, going from the current Lightning charger to what's called USB-C. And there's also going to be a much faster processor and better battery life on the top-end phones. The low-end phones will get some of the iPhone 14 Pro features like the dynamic island, that new area at the top of the phone, as well as a better camera on the back.
So how much of everything you're talking about played into Apple's decision to ask suppliers to keep the production of iPhone units in line with last year at 85 million units, which I found just a little bit confusing because phone sales have been declining over the past 8 quarters. So what did you make of that decision?
Yeah, so 85 million would mean flat for the 3rd year in a row. The 13 was a very small upgrade. The 14 was a small to modest upgrade. I would say the 15 is not a generational upgrade, right? But it is significant. And so I think let's look at it this way, right? If it was a minor update this year, I think units would actually be declining given the overall economy and the overall smartphone market and the tech market in terms of sales and buying power and such, not the stock market. I think the fact that it is a significant upgrade across the 4 models this year is why they're able to keep it flat. You know how sometimes Apple says that, you know, their revenue has gone down, but in a all things current environment, it actually would have been up, right? So something similar to that, where given everything going on, they're able to stay flat because the upgrade is so significant.
Mark, talk to us about, I guess, the latest thinking coming out of Cupertino on China. I can't think of a company that has any more ties, both in the supply chain and source of raw materials, as well as an end market, than Apple does with China. What's their latest thinking about how they're approaching this over the next several years?
Well, I'll tell you one thing, and then I'll answer your question. It feels like the rhetoric around China and Apple working with China and the U.S.-China relations, while that's still there, it feels like it's an idea or a reality, I guess, that has calmed down in recent months, right? Things were really teetering a year ago, 6 months ago even, and people were really pushing for Apple to get out of there. That is no longer the case. Now, to answer your question, nothing has changed over the last year or so. The idea or the plan is still to diversify production as much as possible outside of China. They're building up more lines for the iPhone in places like India. They're expanding the iPad to places like Vietnam. A lot of Mac production has moved to Vietnam and Malaysia. Right, so they're doing what they can to move out of China, except for one product. It's the iPhone, the one we were just talking about. And in order to get the iPhones in those 85 million quantity that you need to ramp up and be built in 2 months' time and to be deployed globally over a 3-month period, you just can't, and by the way, at the quality they need to do so, you just can't do that outside of Foxconn in China at this point. So that's really what's keeping them there.
So, Mark, we don't get Apple earnings until next week, but slew of tech names reporting this week, making up about 40% of the market cap of the S&P in terms of the names we're going to hear from. Which name are you going to be listening into to indicate how the Apple story may evolve, or are the tech names we're hearing from this week completely separate from the Apple story?
I mean, I know this week we have Meta, we have Alphabet, we have Microsoft, right? Any other big ones that I'm missing?
Some of the social ones, like we've got a Snap this week, some of that stuff, but not necessarily a bellwether for Apple.
I would definitely not include Apple in that group. They have a way of either outperforming or underperforming that group, right? So I think they're a bit of an outlier there in terms of, earnings calls that I'll be paying attention to. Definitely will be Meta, right? I would like to see how their, metaverse play, as they call it, is continuing to go. I want to see what the losses are like. I want to see what they have to say about the Apple product. I want to see if they have any more commentary on that. I want to see what's coming out of Alphabet in terms of their hardware sales. I want to see anything they have to say so far on their new Pixel Fold, right? That thing is $1,800. I have had one for several weeks. I don't think it's particularly great. I also don't think people are particularly buying them up, so I want to pay attention to see what's going on there. One other interesting news item for this week is going to be Samsung Unpacked. That's going to be their new phone launch event that's happening in Korea. And they're going to be announcing their latest phones there, which obviously will be going up against Apple's new devices in the fall. So I'll be interested to see how those all compare. So it's actually going to be quite a busy week and a lot to pay attention to.
Hey, Mark, just real quick, 20 seconds. Apple recently completed their just amazing new headquarters in Cupertino. What percentage of their employees show up there on a given day?
Ooh, what percentage show up on a given day? The headquarters seats about 12,000 to 15,000 people, and then there was a bunch of peripheral buildings around there in the Cupertino, Sunnyvale, larger Santa Clara Valley, Silicon Valley area. I would say the majority of employees are coming in 3 times a week. That's typical. Most employees are there Tuesday.
They better be happy employees. The stock's up 50% this year on a compounded basis, up over 30% over the last 5 years. They got to be happy.
I mean,
I say get your wealthy keister back in the office. That's just me. All right, Mark Gurman, chief correspondent, technology for Bloomberg News. He's based out there in Silicon Valley. He's drinking the Kool-Aid. Why not? I mean, Apple stock has just been a tank, just been amazing, and it continues. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Bye-bye birdie. Elon Musk has rolled out Twitter's new X logo, replacing the iconic bird. Bloomberg's Peter Elstrom has more.
He has a thing for the letter X. Of course, he also runs SpaceX, the rocket company. At Tesla, they've got a Model X, and one of his earliest companies was called X also. This was the predecessor to PayPal. What he's trying to do now kind of harkens back to those early efforts where he wants to evolve Twitter from just a messaging platform. He wants to be able to do payments and do audio and video and those sorts of things.
Thanks, Peter. Dozens of drugs made by Pfizer may be harder for hospitals to purchase after a tornado damaged its North Carolina plant last week. Bloomberg's Gina Cervetti reports.
Pfizer said that 65 different formats and formulations of products, including the anesthetic lidocaine, the painkiller morphine, and other basic hospital medicines, may see continued or new supply disruptions in the near term.
Thanks, Gina. Shares of Pfizer currently up less than 1%. Johnson & Johnson is splitting off shares of its former consumer health business. The pharmaceutical giant says the separation of at least 80.1% of its shares of Kenvue will sharpen J&J's focus on its pharmaceutical and medical technology business. Shareholders can exchange shares of J&J common stock for shares of Kenvue common stock at a 7% discount. Johnson & Johnson stock right now up less than 1%. And the NBA Board of Governors has approved Michael Jordan's sale of the Charlotte Hornets. Sources tell the Associated Press the team will go to an ownership group led by Gabe Plotkin and Rick Schnall, but Jordan will remain on as a minority owner. Those are the company stories we're following this hour. I'm Steve Rappaport.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It is 12:21 on Wall Street. We check the markets for you all day long here at Bloomberg. Stocks are higher. That's as investors start to think maybe when the Fed raises interest rates later this week, Wednesday, it's expected that maybe that'll be the last one for a while. And Dan Suzuki is Deputy Chief Investment Officer at Richard Bernstein Advisors. He is sounding the alarm, though, on tech stocks when it comes to earnings, but he also says if the economy continues to improve with a soft landing, stocks could rally from here.
There's probably a lot of upside to earnings for industrials, financials, energy, and tech for that matter. You're just paying a lot for it for tech when you can get better earnings growth elsewhere for cheaper.
And that's Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. As I mentioned, stocks are higher. The Dow right now up 194 points. That's a little over 0.5%. The S&P 500, it's up about 20. That's about 0.4%. The NASDAQ, tech-heavy NASDAQ, squeezing out tiny gains up just about 0.1%. Some other tech earnings coming our way this week. Microsoft shares up fractionally. They report tomorrow. Google shares up about 1.5%. It also reports out tomorrow. Its parent does, and investors are watching not only their numbers, but to see what they all say about the positive impact of their plans for AI on future earnings. And watch for snacks and beverage news. Coca-Cola shares fluctuating. McDonald's shares also fluctuating. They'll be reporting tomorrow. And the 10-year yield right now, it is 3.8%. Crude oil, it is higher right now by more than 2%. Let's call it 2.4% at about $78.94 a gallon. Gold, though, moving in the other direction, down about 2%. And that's a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in our Bloomberg Interactive Broker Studio in New York City. You can stream this program. Head over to YouTube, and you just do the old search and say Bloomberg Global News, and that brings you to the simulcast here. All right, let's take a step back here, folks. We've got a lot of central banks going to be issuing decisions about policy, rate policy this week and into next. We've got a ton of earnings this week, and we've got a market that's kind of been, I think, defying expectations in terms of its strength across the board here. I think it's time to kind of get reset and rethink kind of where we go for the remainder of the year. Let's check in with Peter Anderson. He's the CIO at Anderson Capital Management. Peter, thanks so much for joining us here. I guess I want to approach it. Are you buying into what we're seeing in the stock market this year, or do you feel like maybe it's just over the skis a little bit, maybe too much AI in your coffee? I mean, how do you think about it?
Well, great analogy. Yes, I do think there may be a little bit too much emphasis on AI. I mean, we're all very, very excited about the prospects. But remember, last earnings season, I think every single company had something to say about how AI was going to improve making potato chips and semiconductor chips, all kinds of things. So I do think that we're a little bit over enthusiastic. That is the one thing that I'm actually really worried about is we need to tone that down a bit. And AI just didn't come forth last quarter. You know, AI has been slowly creeping up through the systems for years. It's just for some reason when ChatGPT came out that really put the focus on it so that people that were not following AI, I think, perceive that as a grand unveiling of a totally new technology that hasn't been around before. And that's just totally false.
That's interesting. So you think that people were missing out on earlier signs of an AI rally, and therefore they had already kind of missed that trade when the NVIDIA started popping?
Well, it's a little bit more nuanced. So let me say this, that AI has been around in terms of more simple kinds of algorithms, and we are getting smarter and faster in doing this. So there is a lot more to come. It's just that the enthusiasm, I think, needs to be tempered, and that, in my opinion, we're probably about 15 or 20 Nobel Prizes away from truly emulating how humans think. And I think the main fantasy right now about AI is that we're almost there. We're almost to the point where we can have computers that will replicate our creative thought process, et cetera. And it just isn't the case. If you talk to academics that are working original research in the field, they're actually horrified by the general public's perception of how much progress has been made.
All right, so given that backdrop of AI, and obviously the NVIDIA raise last quarter really kind of reset the entire marketplace. Given that backdrop, Peter, do you and your funds, feel like you have proper exposure to whatever trends may develop in AI? And if so, what names kind of get you there?
Oh, yeah. So this might sound like I'm going to contradict what I just said, but bear with me. So I think that in the long term, throwing pure computational power at the AI problem is probably not the actual long-term solution. It has to be more about how we model the human brain. However, I think for at least 5 years, we're going to go down the path of throwing more computational power to solve some of these unanswered questions. And so I'm on that train myself. And so some of the names, of course, NVIDIA is the poster child for throwing raw computational power at a problem that we don't quite fully understand, but we understand enough that we think if we can get more computational power on that, then we will get closer to the true holy grail, which is emulating human thought. So NVIDIA is great, super microcomputer. These are names that are in the top holdings of my strategy. I only have 15 stocks, so they are very concentrated to begin with. But those are solid names. And Schrodinger, for instance, is another name that will benefit greatly from any kind of incremental progress we make on artificial intelligence. Schrodinger does computational discovery of new drug formulation that's going to save researchers years in terms of getting this up to product.
Super microcomputer. I've never heard of it, which doesn't mean anything. I've only been doing this for 35 years. The stock is up 270% this year, up 500% over the trailing 12 months. What is this company, and why is it like up 5x over the past year?
It's one of the first companies that NVIDIA formally partnered with to help bring to the commercial production its graphics processing units. So they're almost joined at the hip. So instead of focusing purely on NVIDIA and maybe having too much concentration on one stock, a prudent way to play AI is to use both of those companies. They actually take the GPUs and assemble them in certain configurations that are custom made for the end user client. So you can see that they are inextricably connected. And that's why they've moved up in lockstep with NVIDIA, frankly.
Okay, one of the names that you have on your list that I was so excited to see that you had in that top 15 is Coty, and this is the brand that bought out Kylie Jenner's makeup brand, including the Kylie lip kit, of course, and Kim Kardashian skincare brand. Exactly.
Kardashian.
Exactly, Paul. So, Peter, talk to me about why you were drawn to this name and what makes you excited about it, even as the consumer starts to buckle a little bit.
Yes, and I included that to, prove to you that I'm just not a tech investor, okay? That, you could load up a portfolio on all tech stocks, but I do like fundamentals. And Coty, I wish there were more simple stories like Coty around to invest in. So what Coty does is they bought a mid-level cosmetics division from Procter & Gamble several years ago. This is a recovery story. And they kind of lost their way, and they levered themselves up to the eyeball to do this. And along the way, they discovered, gee, maybe we aren't a mid-level cosmetics company. Maybe we're on the high end. So they got rid of the CEO, put a new CEO in that has experience with higher end cosmetics, and they have pledged on record to de-lever the company. And I'm a former bond investor, and nothing makes me happier than when I hear of a company that admits to the public, hey, we lost our way, we're fixing it, and we're going to de-lever, and we promise you we will get down to 2 times leverage. I mean, now they're 5 or 6 times levered, and we've made mistakes, and we're going back to our knitting. That's a classic story that anybody can understand. You don't have to debate about the pros and cons of artificial intelligence. You just have to know that here's a company that makes simple products and has lost its way and now has a great recovery story that they're playing out in front of our eyes right now.
So, Peter, given that holding, consumer-based holding, what is your view of the consumer here going forward?
Incredibly resilient. I mean, we've had 10 hikes, and we're not even really halfway through those hikes in terms of working them through the system. I mean, if I could just go off on a little bit of tangent, I'm amazed that people think that, we've got 4 of the 10 hikes are seasoned to be a year old now, right? And look at the changes that have happened just with those 4 of the 10 hikes. So when the Fed reacts to data, such as consumer health, et cetera, and the markets think that the Fed should react instantaneously to that, I don't understand what the hypothesis is. They must be thinking that the rate hikes have instantaneous reaction. And so the consumer, through all of this, has been insanely resilient. And I think the one problem is, as I said, we're only 40% through the hikes. And so I'm hoping that the Fed is wise enough to say, this stuff takes about a year to go through. We've stressed the heck out of the consumer in theory, but so far they've been very resilient.
All right, Peter, great talking to you once again. Peter Anderson, owner and founder of Anderson Capital Management, with some good perspective there. Right now, let's head down to Washington, D.C., World and National News with Nathan Hager.
Appreciate it, Paul. Thank you. Israel has passed its controversial judicial overhaul that would weaken judges' ability to overturn government decisions and appointments. Prime Minister Benjamin Netanyahu's coalition government approved the measure by a 64-0 vote today. Opposition lawmakers walked out of the Knesset in protest. Bloomberg's Anne-Marie Hordern has more from Washington, where the White House has been watching the situation.
We just had the president of Israel here in the United States. There was a joint session of Congress, this address he delivered. He also met with President Biden, and also was announced this invitation to Netanyahu. But interesting, no date or time was in that invitation. It was just, Bibi, we hope at some point you can come to the United States.
Bloomberg's Anne-Marie Hordern in Washington. Now, the White House has put out a statement following the vote, calling it unfortunate that it took place with the slimmest possible majority. The White House says the U.S. will continue to support the efforts of President Isaac Herzog and other leaders in Israel to build a broader consensus. In East Africa, a suicide bomber targeted a military training camp in the capital of Somalia, Mogadishu, today. A senior army officer says 25 soldiers were killed, 40 others wounded at least. Al-Qaeda's Somali-based affiliate Al-Shabaab has claimed responsibility. The Biden administration is reportedly considering a deal with China to tackle opioids. According to the Wall Street Journal, Secretary of State Antony Blinken discussed lifting sanctions on a Chinese police forensics institute suspected of human rights abuses in a bid for greater cooperation on fentanyl. Surprise no more from the IRS. The tax agency says it will no longer send agents on surprise visits to homes and businesses. The New York Times reports this rolls back a policy that has been key to IRS efforts to collect unpaid taxes for decades. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 12:41 on Wall Street. We check the markets for you all day long here at Bloomberg. Stocks are broadly higher. Investors eyeing the Fed, the two-day meeting Tuesday and Wednesday. The Fed, of course, widely expected to raise interest rates one more time and then maybe stand pat after that. We'll be tracking it all live for you here on Bloomberg Radio. And Lori Calvasina, she's head of U.S. equity strategy at RBC Capital Markets. She says it's really all about the Fed and about earnings.
I think it's going to be all about earnings. One of the things our rate strategy team has talked about on the Fed is they think the Fed narrative is likely to stay kind of boring for a while. And I think equity investors have already come to that conclusion that we're probably going to get one more hike. That's probably the end of it.
And that's Lori Calvasina, head of U.S. equity strategy, RBC Capital Markets, on the Bloomberg Daybreak podcast. The Dow right now up about 191 points, holding steady right now, just about 0.5% higher. The S&P 500, it's slightly higher, up 20 points now, up about 0.4%. The NASDAQ up about 20 points. That is about 0.1%. The 10-year yield, 3.85%, let's call it now. Spot gold, it is lower by about just fractionally at $19.59 an ounce. And crude oil right now, we are still seeing that rally in crude oil hold. Crude oil right now up about 2.67%. Apple shares, they've been trading higher all day. We're hearing Apple is asking suppliers to produce about 85 million units of the iPhone this year. That's roughly in line with last year, despite a projected decline in overall global smartphone demand. And sources tell us here at Bloomberg, Apple guys likely to increase revenue because it's considering raising the prices for those Pro models. So if you're on a budget, maybe stick to that current version of the Pro or an older version of the Pro model instead. And that is a Bloomberg Business Flash. Back over to you guys.
All right, Denise Pellegrini, thank you so much. We appreciate it. We've been calling out WTI crude oil here for the last several weeks because it's had a nice little rally here, up another 2.7% here to $79.15. And we want to talk global energy. We talked to Fernando Valle. He is the senior analyst covering all the energy complex for Bloomberg Intelligence. Fernando, thanks for joining us. Let's start with Chevron. They just reported results recently. What did we learn about Chevron, and what does it tell us about global oil?
It was a really interesting decision. They pre-announced, in fact, last night when their full earnings are expected on Friday. It's a very unusual move for Chevron, especially because the earnings were actually pretty much in line with expectations. They had $6 billion in earnings, 5.8 for adjusted earnings versus a consensus expectation of 5.5. So slightly better. But what's most interesting was the changes in management. Essentially, their CFO, Pierre Berber, is going to retire next year. But more importantly, and I think one of the reasons there's some positive momentum, is CEO Mike Wirth is going to be allowed to continue past the 65-year-old mandatory retirement age. So that would put him in place to stay beyond 2025 and continue pushing Chevron information, which for us was going deeper into shale, deeper into liquid renewable fuels, and closing the gap and actually overcoming ExxonMobil as the most expensive big oil major by EV to EBITDA metrics.
Okay, so to what extent is the Chevron beat on earnings forecasts, at least, related to those management changes versus broader trends that might get a read-through to those other oil names like an Exxon?
Well, there's certainly a big portion of it that's just oil prices, but the biggest component has been the changes that they've affected over the past 5 to 8 years. Chevron has always been the more conservative, at least over the past 15 years. They moved into being a more shale focused. They're the second largest landholder in the Permian. That region produced 772,000 barrels a day in the second quarter, so a very significant portion of its overall global production of just north of 3 million barrels a day. And then they've been acquisitive. They're just going to announce they're going to close the deal for PDC Energy in August. So there's been a lot of changes, and as opposed to Exxon that in the past had gone into high-cost areas like Canadian oil sands or built some loss-leading projects in Russia, Chevron stayed a little bit more focused, and as I mentioned, grew in shale, grew in LNG, two of the most important areas of the energy sector for the next decade.
So do you expect Chevron and the other players in the shale plays here in the U.S. to continue to ramp up production? What are their plans?
Certainly, Exxon and Chevron and ConocoPhillips will continue to grow, and those players, together with Pioneer, will account for over 35% of all of the Permian's production by the end of the decade at this pace. It's more and more going to be concentrated on these large players, and they have the balance sheet and the flexibility to continue growing even as oil prices are lower. So I'll point that Chevron's announcement said that they essentially consumed cash in the quarter. They continued investing at very high rates despite lower operating cash flow than the past year, and they continued a very aggressive share buyback program because they've built in that flexibility on their balance sheet.
What would you say, Fernando, is the single biggest thing that impacts the price at the pump for the consumer at the end of this equation? Is it something like OPEC cuts? Is it earnings? What is the single biggest indicator there?
Well, I think ultimately everything revolves around interest rates and consumption and growth. Oil is one of the most important inputs in our whole industrial complex. And so if we impact overall demand, that will lead to lower consumption of oil. And there's nothing OPEC or Chevron can really do to affect that. So the impact of interest rates, which is still being felt, is probably going to be the most important long-term factor. In the short term, yes, OPEC plus shale will have its say, and that's what potentially is driving the Brent and WTI rallies over the past month, because the OPEC cuts really went into effect July 1st, the extended OPEC plus cuts. So that's giving it some balance, but I think over the long term, it's all about demand, and that's really set on Fed policy and then ultimately on energy transition.
So you've told us in the past that, a production cut by OPEC is a sign of weakness, i.e. demand is not there. What are some of the big, oil majors? What are they saying about demand over the next, 12 to 18 months?
Well, they're saying they're going to be ready, whatever it is, and that's why they built that balance sheet flexibility. And it's a non-answer, but it's not my non-answer. I think I'm just parroting that one, but I think ultimately that is what they should do. They are price takers at the end of the day. Demand, when you look at the Fed potentially rising rates again, as we heard just before our segment, we've heard about credit card debt, interest rates impacting mortgage as well. We don't think we're through. We're on the 8th inning of the interest rates impact, and earnings, not just for the energy sector, but for the broader economy in general, are going to be impactful in how we determine the effects on the consumer and ultimately where we're going to land, if it's a soft landing or anywhere between soft and a hard landing for the economy.
Well, and in our final kind of 30 seconds with you, Fernando, I'm always curious about what the outlook is for the price of oil when we head into an election year. What is your current read on what prices at the pump could be looking like as we head closer and closer to November 2024?
If there's a hard landing, I think we're going to be lower, and that. But then the economy is not in a great place, right. So it may not matter for the incumbent. So I think ultimately we're coming into a scenario where the consumer is struggling a little bit. The supply has been cut, so either the demand isn't there and it's going to get worse, or we're going to head to much higher oil prices in 2024 and beyond.
All right, Fernando, thanks so much for joining us. As always, our go-to voice on global energy, Fernando Valle. He is senior analyst for Bloomberg Intelligence. Chevron pre-announcing some results, pretty solid from the profit perspective, despite the year-over-year decline in oil prices. Although oil prices just in the last month, down around 67 up to where we are here today, it's $79. So a nice move just recently off of the recent little bit of low here. So we'll pay attention. We've got more energy earnings coming up this week. I got a lot of earnings just in general this week, probably for the market, going to be most focused on those technology numbers coming out later in the week, and we'll stay on top of that. We'll have more coming up. This is Bloomberg. Let's get get some company news right now with Steve Rappaport.
Paul, Tesla is lapping its German competitors in the EV race. Bloomberg's Gina Cervetti reports.
The Elon Musk-run company delivered just over 889,000 cars in the first half of the year. That's more EVs than Volkswagen, BMW, Mercedes-Benz, and Porsche combined.
Thanks, Gina. Tesla also announced it's unveiling an 84-month auto loan. CEO Elon Musk said it was in response to rising interest rates. While extending loan terms can lower buyers' monthly payments, consumers tend to pay more in interest and face a greater risk of eventually owing more than what their vehicle is worth. Tesla shares are currently up right now more than 2%. Apple is keeping its iPhone shipments steady, asking suppliers to produce about 85 million units of the iPhone 15 this year. More on that from Bloomberg Intelligence analyst Mandeep Singh.
Clearly, I think this calms down the nerves in terms of Apple really seeing a big decline with their new launch. But, flat shipment isn't very encouraging, although I would say you will see ASP growth with any new Apple product launch.
Thanks, Mandeep. Shares of Apple are up less than 1%. Paul, do you know today is Stan Lee's, or what would have been Stan Lee's 100th birthday?
Did not know that.
Well, Cartoon Studios put out a batch of more than 8,000 Stan Lee digital collectibles, and the company says that they sold out nearly instantly today. The release was in commemoration again of what would have been his birthday. These items netted about $15 each for a grand haul of about $120,000 in revenue. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio in New York City. S&P 500 up 0.4%. The Dow up 0.5%, 195 points. And NASDAQ a little bit softer, up about 0.1%. Yields, let's call those out. The 10-year Treasury yield up about 1 basis point, 3.84 on your 10-year, 4.88 on your 2-year. So still plenty of inversion out there. And again, WTI crude oil up 2.8%, just above $79 a barrel. Right now, let's head down to Washington, D.C. We'll get world and national news with Nancy Lyons.
Thanks, Paul. Nearly a week after a U.S. soldier crossed the border into North Korea, the UN command has started talks with North Korea's military. We get the latest from Bloomberg's Amy Morris.
23-year-old Private Second Class Travis King was whisked away by North Korean military personnel, but there hasn't been any information about his status from North Korea at all, not even a mention in their official media. He's likely facing intensive interrogation somewhere in Pyongyang. The deputy commander for the UN command says the primary concern is King's welfare, so they have started discussions through the mechanisms of the armistice agreement, the ceasefire deal that ended fighting in the Korean War. In Washington, I'm Amy Morris, Bloomberg Radio.
South Korea's military is confirming through a text that North Korea has fired a ballistic missile into the East Sea. Today's news comes as a second U.S. nuclear sub has docked in South Korea. The USS Annapolis will resupply while it conducts a broader operations mission. That's according to South Korean officials. About a week ago, the USS Kentucky docked in Port Busan in the first visit by a U.S. nuclear sub to South Korea since 1981. Members of the Israeli parliament have approved a major part of Prime Minister Benjamin Netanyahu's controversial judicial reform plan. It takes away much of the Supreme Court's power, and it has prompted massive protests. Opposition lawmakers even sat out the vote to express their distaste in getting rid of the checks and balances. Those in favor, though, say the judiciary has grown too powerful and is controlled by the left. UPS and the Teamsters Union will return to the bargaining table this week. Contract negotiations will resume Tuesday and are aimed at averting a strike by 340,000 UPS workers. The Teamsters' 5-year labor deal with the shipping giant expires at the end of this month. It's feared any strike could do tremendous harm to the economy. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Madison.
All right, Nancy, thank you so much. We appreciate it. Looks like our good friends at Adidas. See, I do the correct European pronunciation. Yeah, how about that? Apparently, they improved their guidance for the year after starting to sell its inventory of Yeezy sneakers from a canceled partnership with a rapper and designer Kanye West. So that's good news for them. So apparently, they are sitting on, I think, so Adidas terminated its deal with Yeezy in October after he changed his name to Ye, I guess.
Ye.
Ye, thank you. Made a series of anti-Semitic remarks, leaving about 1.2 billion euros worth of sneakers in limbo. But I guess I figured let's just start dumping them. And that's helping out the results a little bit.
Yeah, really interesting here when it comes to the outlook for Adidas. Preliminary second quarter operating profit set at about 176 million euros, the estimated loss there of 130 million. Again, changing that outlook a little bit after selling those Yeezys there and seeing full year operating loss, again, downgraded just a little bit there after that news that those orders of Yeezy shoes are going up. We've got another headline crossing the terminal that Adidas getting over 508 million euros of orders for Yeezy shoes by June 2nd there. That is according to the Financial Times, but that is certainly going to impact the Adidas earnings outlook heading into a slew of earnings from these retailers in the next couple of weeks.
I can see people buying these things up knowing that there aren't going to be any more ever. So it's kind of a collector's item for a lot of these sneaker folks out there. And they're serious people that invest tons of money in their sneaker collection.
Yeah, but it's also really canceled to be wearing Yeezys because of, because of his vibes, as a whole. So,
all right.
But they did say that they were going to donate the proceeds to organizations that could use that money. So it's questionable to me whether or not this increase in sales is going to necessarily impact their bottom line.
All right, good stuff out of Adidas. Sound On with Joe Matthew. That starts right now.
Than 10 $10 trillion global ETF industry. The Fed decision, as Katie pointed out, is this week. A 25 basis point hike is what we're expecting, but the debate around how many increases are left has yet to settle.
Plus, in just a moment, we're going to speak to BlackRock's Rick Reeder, who is managing his own new flexible income ETF, his first ETF that he is personally at the helm of.
I'm very excited to speak to him. We're going to have a little fun on this Monday. Other than with Rick, we're going to talk about, I should say, the Vice ETF. It holds gaming, alcohol, and cannabis type companies.
And Matt, before we get there, as always, Eric Balchunas from Bloomberg Intelligence here with us now, taking a look at the flows. Eric, what do you got?
Katie, Matt, thank you very much. So we're looking at the flows. We're seeing a continuation of what we've seen for the whole summer, which is a big move back into equities, right? There had been a FOMO drought for the first 4 or 5 months of the year. A lot of people buying treasuries. Now that is changing. IVV at the top at almost $4.7 billion. That's a lot for IVV. You do have a treasury ETF up there. It's a floating rate one, but then you have SPY. You've also got RSP. RSP is interesting. It's equal weighted S&P. This has been seeing a lot of bids lately because people want to play the market, but they don't want to have such exposure to the Super 7, which have been carrying the market up until now. Let's look at the outflows, and you can see that the top 3 ETFs are all treasury ETFs. And again, this is part of this trend from treasuries into equities, BSV, GOVT, and SCHO. More money out of ESG, notable there. But let's focus on treasury ETFs. I want to show you a chart of quarterly flows into treasury ETFs. You can see just how intense the flows have been for about the last 5 or 6 quarters. See how this is what it normally looks like. But look at rate from the beginning of 2022. Bam, I mean, that is a lot of money going into treasuries. They only make up 5% of the assets, but they're taking in about 30% of the flows. That's almost like a mania, right? But the last quarter, it's coming down, and this month, it's almost down to 0. So money's still coming into treasury ETFs, but I will say the mania type flows are gone. They're going into equities now.
Not at the same speed, and FOMO may be back. Eric, thanks very much for that. Joining our conversation now is Rick Reeder, CIO of Global Fixed Income at BlackRock, and you're getting into the ETF game yourself as well, Rick, so we do want to talk about that, but let me first ask you about the overriding trend that Eric was just outlining. We don't have this avalanche into fixed income ETFs that we've been seeing for pretty much the entire year so far. Why do you think that is?
So I think there's a couple of things. The primary one being the Treasury's issuing about 299 billion bills a week, gross, about 70 billion net at 5.5%. So you think about it, you functionally can sit in cash at 5.5, or you go to the long end of the yield curve and get less than 4, and you got to take, very long interest rate, very long duration, very long interest rate sensitivity. I mean, these cash levels are pretty high, and some people say, gosh, I'll take that. We'll talk about, can you get yield in fixed income? You can. But boy, if you carry at 5.5, or you build a portfolio today that gets you some income, and then go in, there's a good chunk of the equity market that's below the average multiple. So, if you're filling out your investment portfolio card today and you said, gosh, what am I going to do? Gosh, I'll carry high, and then I'll buy some equities that have some upside, and that works pretty well.
And I do love that you talk about equities, even as a bond guy, but I want to stick to the bonds right now, because if you look at the bond market in ETFs broken down by maturity, it caught my eye that for the past 2 months, you've seen a lot of money come out of short duration funds. So those maturing in 1 year to 3 years. But then you take a look at ultra short, and it's still holding on to all of those assets that it's taken in so far this year. What is it about the short space that people are getting out of right now?
So first of all, you've got an inverted curve, and today, functionally sitting in cash or cash-like, I know I think I said it on the show we did the other day, that you can own commercial paper, that's 6-month, 9-month commercial paper, and clip over 6 yield, which is pretty incredible. As you think about, if you're, gosh, I could do that, maybe I'll own parts of the high-yield market and or parts of EM and get higher numbers, 8, 9, 10, and so to sit in some with an inverted curve, to sit in some of these areas that are not paying you a lot doesn't make a lot of sense. So I'm sure there's some of that dynamic at play today. You look at. So go ahead. No,
well, Rick, you mentioned the inverted curve, and I've just been kind of obsessing over this for the last few hours, and of course this year we've all been watching that. Now, the reason I've been thinking about it, Ed Yardeni thinks he has an explanation for the incredible inversion we've seen. I mean, 3 months, 10-year, over 150 basis points, right? And everyone's saying, does that mean a recession's coming, or what is it signaling? Because the economy, the real economy data that we have looks very good. So Yardeni says maybe the inversion of the yield curve just means that inflation is coming down at a rapid pace and not necessarily flagging a recession as it has the last, 7 times. What's your take on that debate?
So I think the inversion of the yield curve is a good indicator of recession, but it's been wrong. I think it's like it predicted 9 of the last 3 recessions. I don't think it's a great, I don't think it is a great indicator. And you think about what's happening today. You used to have an economy that was very interest rate sensitive. The economy today is not interest rate sensitive. The companies that borrow for CapEx, the companies that spend on CapEx today, you think about the big tech companies that are spending on AI, or the Googles, the Microsoft, the Apples, they don't really borrow. They use free cash flow. People have already locked in their mortgages at 3.5, so you don't have interest rate sensitivity there. The economy is just not, and you think about all the hiring in the economy, healthcare, education, these are not interest sensitive dynamics. So what happens is the Fed lifts the front end of the yield curve up, and you don't create that much of an impact, but like you say, inflation is coming down. So you create this inversion in an economy that's actually resistant to or less sensitive to interest rate hikes, and so it's not, I would argue, it's not a good indicator at all.
Speaking of indicators, I read an interview with you from a couple of weeks ago. You talked about you pay a lot less attention to surveys, where it's people's opinions about what's going to happen. You'd much rather read earnings reports. And so we have a lot of earnings coming up. I'm just curious what you're looking for in the next couple of weeks there.
Yeah, I mean, by the way, I find some of these surveys where they poll 500 people, they're similar to election polls. Like, people talk about what they feel like, and then actually, they could be in a bad mood, but they keep spending. So I don't find these surveys terribly robust. And it just swings like everything else with Sun. What am I looking for? I'm looking for top line. I'm looking for what are revenues on a top line basis in an economy that's operating pretty well. But I'm also looking at, there's real dispersion in some of these companies today. So you look at some of the retailers, apparel, electronics, furniture, that have been struggling a bit, but gosh, and then you look at travel, it's operating really, really well. The airlines, the cruise lines, the hotels. So I'm looking at dispersion, and then, quite frankly, one of the things that around, tech drives so much today is what's happening with search, what's happening with advertising spend, and those are going to be pretty important numbers to look at today. But I'm pretty keyed in on top line revenue, and are companies able to keep their margins at a reasonably stable level given some of the input costs have gone up.
Well, Rick, it's going to be a really interesting week for you because I believe we have 165 companies in the S&P 500 reporting this week. We don't have too much time with you before the break. You're sticking with us. But before we go to commercial, I do want to ask about your thoughts on high yield credit, because it's not lost on me that junk has been really performing well this year. Then you take a look at the flows. You've had nearly $6 billion leave from junk ETFs, whereas fixed income ETFs overall have taken in over $100 billion. Why does no one want to buy into this junk rally?
So a couple of things. One, I mean, you can get yield in a bunch of other places. We talked about EM. We talked about some of the quality yields you can get that are pretty attractive today. And quite frankly, part of high yield today, if you're doing it in a passive way, half the index trades at tighter than 300 spread and half trades above 800. So you're getting a lot of tight stuff, and you're getting a lot of what I would argue companies that are under some stress. Part of why we're doing this in our ETF is being selective around the names that are actually paying you for the risk. That makes a lot of sense. And then the other side of it is, if you're using beta in your portfolio, equities are doing a whole lot for you in terms of using that beta bucket. If you can get income in other ways, in safer ways, then that's what, as you're saying, if you fill out your investment portfolio card, a lot of safe carry, and then get the beta that's really working for you has made a ton of sense.
All right, Rick, a bond market veteran, doing your first ETF. We're going to talk about that when we come back. I've already got viewer questions here pouring in, so a little bit more time with Rick Reeder. This is ETF IQ on Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time. And then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the night effect funds due to shut down. Of course, these were from night shares, basically to mimic the overnight performance of both the S&P 500 and the Russell 2000. But those overnight gains, as you can see, have proved elusive, if you will. You have the S&P 500 overnight version in orange, the Russell 2000 in white, and their actual benchmarks above that. You can see that they have been underperforming, and as such, they're going to shut down. Let's also talk about Grayscale, though. This, of course, is a story that we've been following closely on this show. Grayscale applied to convert GBTC into an ETF. The SEC rejected that. They sued the SEC. We're expecting a decision by the end of September, according to Bloomberg Intelligence. As you can see, GBTC's discount to its net asset value has really narrowed in anticipation of that. So definitely one to keep an eye on over the next few months. And let's go back to BlackRock. It's our theme of the show, if you will. We're going to talk now about the BlackRock Flexible Income ETF. It launched at the end of May. If you compare that against IUSB, it's actually handily outperformed. Bank up 1.4% on a total return basis. IUSB up 0.6%. So it's early, Matt, but it's going well.
Yeah. It seems to be going quite well. We're back with Rick Reeder, CIO of Global Fixed Income over at BlackRock. And Rick, as I said, I've got a lot of viewer questions coming in for you. Essentially, I think the heart of these questions is, it doesn't feel like you're being paid to take credit risk here. You're just buying the yield curve. What do you think about that idea?
So, I mean, listen, I mean, part of the argument against high yield this year has been the spread's not interesting at all. And, but you can create, I mean, there are a bunch of parts of the fixed income market that actually you are getting paid for. There are parts of credit. By the way, European high yield, if you're a dollar investor, you swap it back to dollars and you get paid well into the nines for getting that. That strikes me as fair. We talk about parts of EM where you're taking risk in Mexico, sovereign risk in Mexico, that you're getting paid low double digits local rates. And the securitization market is really interesting. CLO market, you buy AAA CLOs, not taking a lot of credit risk. The non-agency mortgage market is interesting today for the same reason. I mean, the residential mortgage market is in good shape. So, listen, if you said, you know, what do you think of high yield or high grade spreads if you're just buying that current spread? Yeah, I mean, it's a fair argument. It's not certainly relative to history, it's not that cheap. Most of the yield you're getting is coming through the risk-free rate. And you know, that's part of the idea of, like, you can hide in parts of the front end of the yield curve and get a lot of carry.
Well, specific.
You know, by the way, I mean, no, I was going to say one thing on the ETF. We're running a duration. You know, you can create a 7. You know, the yield we're running is about a 7 with a duration or interest rate sensitivity. That's about 2, and so that pretty appealing today in an environment where do you want to take a lot of rate risk out the curve?
Well, Rick, you mentioned Mexico, and I want to talk international because I'm looking at the ETF BINC right now, and I see that 22% of the fund is in non-U.S. credit. So when you think about really the global fixed income market right now, where is most of the opportunity? Are you going to find that in U.S. bonds, or how much are you looking to overseas relative to where you usually tilt?
So, listen, the U.S. is always, in fixed income, it's pretty hard not to have the U.S. as a core part of your portfolio, particularly when you've got these yields. For the front end of the yield curve, real rates are over 300 basis points. The average, I think, over the last 10 years is negative 50, negative 60. So it's pretty hard not to have a core part of your portfolio in the U.S. But European credit, European IG, investment grade credit, European high yield, swap back to dollars. You can buy a lot of reasonable companies without going far out the yield curve at an awful lot of yield, particularly as a dollar investor. And then the other one being EM. We talked about Mexico, Brazil, the rates market in Brazil, Colombia. There are, you're getting paid local rates. As long as you're willing to take some currency risk in EM, they're pretty darn attractive. And the currencies have actually not only not hurt you from a hedging point, they've actually been a real help. As you've got money flowing into Mexico as a big winner in the deglobalization dynamic. Same in currency in Brazil, doing really well.
And just real quick, this ETF is interesting to me because it does take a lot of risk relative to other active fixed income ETFs, which typically benchmark against the ag. You're benchmarked against the universal, which is actually a little harder to beat, in my opinion. How far out there are you purposely going? Are you trying to add a lot of active share? So this is a complement to, say, the ag exposure that a lot of people have?
100%. The idea around this is to create, there's a lot of investment that goes into HYG, into the traditional passive JNK, traditional passive fixed income ETFs, which, by the way, are great ways to get exposure into those. What we're trying to do is create more yield, but be really active around getting where your exposure is coming from, being tactical about, when it makes sense to own agency mortgages versus owning emerging markets, et cetera. So the idea being, can we hold a higher yield and then be aggressive about moving it around to where we think the best opportunity presents itself? There are times where the new issue market presents opportunity. Now in the securitization market, as well chronicled, banks are selling assets. There's some assets that are trading at very reasonable levels.
All right, Rick, we got to leave it there, but come back soon. This was great. That is Rick Reeder of BlackRock talking about BINC. Still ahead, we're going to drill down into commodities with Kathy Krisky. She is product strategist over at Invesco. That conversation next. This is ETF IQ on Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, refocus on one ETF. Eric, what do you got?
Katie, today we have DBA, which is the Invesco DB Agriculture Fund. This holds agriculture futures, right? So we're talking stuff like sugar, cocoa, live cattle, soybeans, coffee, a lot of things people know and love, but you can't store this. You got to use futures, and that's what this does. 870 million. This is basically over half of the whole category. So this is the big dog in the category here. 91 bips, a little pricey, but it's pretty exotic exposure. You can see it's been around for a long time, launched in 2007. Let's look at the holdings. I kind of already rattled them off, but what I do want to point out is sugar. This thing has been on fire this year. Sugar has been up about 43% overall, lifting DBA up a lot. And so I do want to go ahead and look at the performance of DBA versus DBC. DBC is all commodities, including energy, right? Energy has been, if we can show the returns here, energy has been down a little bit. So look, ags beating the broad commodities. I threw this other guy in here that's PDBA. For people who don't like the K1, and this is a little cheaper, this is their newer version of it. So Matt, Katie, really ags sort of leading the way in the commodities department right now, and this thing is definitely benefiting.
Eric, thank you. And joining us now to talk about this ETF is Kathy Kriske. She is product strategist of commodities and alternatives for Invesco, joining us on set, which is a particular delight. And Kathy, part of the reason I'm so excited to talk to you is it feels like we're having so much extreme weather, not just in the U.S., but across the globe. And when you think about what DBA holds, how are you seeing that ripple across its holdings?
This has been a tremendous time. So, and I have to say, if I had to, one phrase to think about with agriculture is war and weather. That's it, right? And we are seeing extremes in both. So weather, as you mentioned, the hot temperatures, right? They're global, right? And they're impacting all of them. So Eric mentioned that the ETFs that we were talking about have grains and softs and livestock. And this extreme weather is affecting every single category. I love that you brought up sugar, Eric, because I write about it and I said the sugar rush, right? We've had a tremendous move up in sugar. It's over 50% year to date. And that's been a big performer. Why? Because we had extreme weather, right? And think about India, Thailand, those are the primary, and Brazil, primary areas for sugar. So that is a big issue. But also the grains, right? And remember, it's not just the crops that are being damaged, also the transportation, the Mississippi River. When we have a drought, it goes lower and it makes it harder to transport those grains. So that is also a big issue.
How much do you think about legislation or regulation? Because when you talk about sugar in Brazil or we talk about corn here, I think about fuel, you know, and a lot of that is sort of pushed onto the industry or onto consumers by regulation. Does it make a big difference?
It does, but look at the lean hogs right now. So there's Prop 12, which is in California. It's limiting how they can treat the lean hogs there, and so that is affecting the price of pork, right? But yeah, also soybeans, right, being used for biodiesel. That is causing a lot of demand. And that's what's been sort of interesting for the grains as they become energy crops, right? We think of them as just food or food for humans and food for livestock, but they're also energy crops, right? We all know ethanol, sugar and corn for ethanol, but also soybeans for this biodiesel.
And just real quick, I'm looking at all these commodities in here. We've got coffee. You never know which one of these is just going to go wild, right?
Exactly.
Sugar went wild already. What's a good pick for like the second half or next year? Which one in here are you most excited about?
Well, one of the things that we didn't mention was El Nino, right? So now they've announced it's 81% chance that we're going to have a moderate to strong El Nino, and that is going to impact all the softs, right? Certainly. But I still like sugar, but I think that, also like soybeans, wheat, corn, they're all going to be impacted. And that's the problem, is that we have weather volatility, right, which we haven't seen. And also just generally about the geopolitics is we haven't had geopolitics built into our prices until last week. Last week changed everything with the Putin pulling out of that Black Sea grain initiative. And at first the market discounted it because they said, well, how much was really getting exported? But as the rhetoric between these two rivaling, counterparties, as that got more extreme, and they talked about bombing one another and understanding that they can board any ship. The insurers were like, why would we insure these ships, right, that are carrying these grains? And then, I was thinking about wrote up notes on Friday, and then this morning, right, seeing the Danube, I thought, okay, no problem. Things can be transported on the river, right, rather than through the Odessa. No, they've used drones to bomb that, right, area, and now with Odessa too. So this has all escalated, and that's why we've seen this big move up in a lot of commodities, but especially wheat. And the really important thing is diversification when you're investing. Don't just buy wheat. That is dangerous. What we saw with the original geopolitics was wheat went skyrocketing, and then it came crashing down. So that's important, right? Diversify, and that's why we talk about DBA and PDBA. You're across all sectors of agriculture.
It's interesting. So war and weather, but you know what? War has always been so obviously an effect on the macro. We're starting to see, I mean, we need to get on your distribution note now, because we're starting to see the ags really affect the macro picture.
Exactly. And that's why it's sort of interesting as a commodity person, because everyone focuses on energy, right? Energy first, then metals, and lastly, ags. And we think, again, PwC having a 10% return, PDBA versus the PwC, the comparison that you did, because energy's been a drag. I personally think the second half of this year is going to be very different from the first half in terms of, right, we all know in energy we are going to have constrained supply, right? OPEC's taken all these barrels off. We are seeing some demand out of China, and even Russia is cutting some production. So we do think that the commodity group as a whole will change for the second half, but it was a horrible first half.
Kathy, thanks so much for joining us. Pleasure having you here. Kathy Kriske from Invesco. That does it for Bloomberg ETF IQ. I'm Matt Miller with Katie Greifeld and Eric Balchunas. This is Bloomberg.
We have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of the markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
Welcome to Bloomberg Markets. I'm John Ehrlichman.
And I'm Matt Miller. Let's get a quick check on the markets right now. We do see equity indexes rising right now with the S&P 500 gaining about 0.5% at 45.57 as we head into a week with 165 companies on the S&P 500, more than $14 trillion of market cap in that one index alone reporting. So it's a big week for earnings. You do see the 10-year yield coming up right now, a little bit more than 2 basis points. Right now, 385.67. We're going to talk a lot about yields in this program because the curve inversion has been getting bigger, but there are a couple of really big names in the markets that say not to worry. That doesn't necessarily mean that a recession is here or coming. The Bloomberg U.S. Dollar Index back down again after marching up for the whole last week. Remember, it had come all the way down to 1,200, but now we're back up at 12.15. And you do see NYMEX crude. That is not Brent. You're looking at the right print there for West Texas Intermediate, higher by $2 to 79.18. John, what are you looking at?
Well, I'm definitely looking at energy, Matt. It'd be interesting to see if you could see crude get back to around that $80 level. Hasn't closed there since April, but it is definitely giving some momentum to energy stocks. Whether it's Toronto or New York, you got Halliburton up almost 4% at this hour. Big move, record move, actually. Becton Dickinson up about 5.5% after some encouraging FDA updates. Of course, there are winners. There can also be losers. We have seen a decline in Gilead Sciences shares today, for example, after a disappointment in its drug trials specifically, and Spotify under some pressure. Consumers don't necessarily like price hikes, but Spotify pushing a few through for their premium subscribers, and doing so, by the way, Matt, in a week where they'll have earnings, and obviously earnings is going to be one of the big themes for the week overall.
Yeah, earnings is huge right now. In fact, a lot of people out there are saying, don't worry as much about the Fed now. Earnings are on the front burner. Let's talk, though, a little bit about what's going on in the macro. Wall Street's top economists say the risk of a recession is fading fast. But the message being sent by a bond market yield curve inversion keeps getting louder. I'm not just talking about the 2s, 10s here. We're talking about the 3-month, 10-year Treasury curve. This is what Jerome Powell says is more important to him and has predicted the last 7 recessions. Ed Yardeni calls the scenario that we're in right now a nirvana scenario, all gain without much pain. He's here to talk with us of Yardeni Research. Ed, great pleasure having you here. Thank you so much for your time.
Thank you.
I read, your supposition this morning about what the yield curve may mean, and I thought, oh my goodness, it's elementary. How had I not thought of that previously? It doesn't necessarily mean there's a recession coming. It just means that inflation is coming down at a rapid pace. Why haven't we been hearing more of this?
Well, I think the inverted yield curve really has predicted a process. In the past, what would happen is as the interest rates rose, as the Fed raised interest rates, at some point, bond investor would say, if the Fed keeps going like this, something's going to break in the financial system. And they start buying bonds at a yield below the 2-year, for example. And then sure enough, something would break in the financial system, and that would become then a economy-wide credit crunch, which then clearly would cause a recession. So it's a process, and it's had a very good track record of predicting recessions as a result. But in the current situation, it's done a great job of anticipating a financial crisis. We had that in the banking sector back in March, but the Fed came in so rapidly, providing liquidity, that it hasn't morphed into a credit crunch and into a recession. And I think what the bond market investors are anticipating now is that we might actually be able to have an economy growing with inflation moderating. And by the way, our inflation rate is very much determined by what happens over in China. China's economy is weak, Europe's economy is weak, the global economy is weak. And so global investors are looking not just at the U.S. situation, but the global one. And they see a situation where globally the economy is weak and the U.S. may be doing relatively well and inflation is coming down. Let's buy bonds at yields below the 2-year. That's what's happening.
Ed, I want to ask you a question about something I really genuinely don't understand, and that is, Bill Dudley a couple months ago was talking about the term premium being too small, and Jan Hatzius at Goldman Sachs writes about the fact that the term premium is a lot less now. That is, of course, what investors are demanding to lend money for longer durations than shorter durations. Why is that term premium, why has it shrunk?
Well, I think first of all, there's a tremendous amount of liquidity still in the system. I know there's been a lot of focus on excess savings on the part of consumers, and by some estimates, there's $500 billion to $1 trillion in excess savings. But the idea there is that they're going to be spending it, and that when they stop spending it, when they run out of it, that the economy goes into recession. But there's a lot more liquidity than that. If you look at the sum of demand deposits, forget that. Look at the sum of all deposits and money market mutual funds. It's an all-time record high of over $20 trillion. There's a tremendous amount of precautionary liquidity out there. And right now, that liquidity is earning a pretty good yield at 4 or 5% in the money markets. But investors who are invested in those short-term instruments have to be concerned about, well, what happens down the road when and if short-term rates start coming down? Will I have missed an opportunity to buy bonds at a relatively attractive level? And so I think that's what's driving the situation is liquidity and a concern that inflation might actually come down. So you might miss an opportunity in the bond market.
And let's also tie this back, Ed, to the equity world, because you put forward a fairly bullish thesis when there were still plenty of bears dancing around. Let's face it, we've seen a more than 25% move in the S&P 500 off the October lows. You've been still floating a range going into, I believe, next year, somewhere between 4,800 and 5,400 for the S&P 500, which could mean maybe a 5% lift, could also mean getting closer to another 20% from here. Is that a fair characterization of your view?
It is. I've been in the camp that has been arguing that we're in a recession. It just happens to be a rolling recession, hitting different sectors at different times. Now, I would say we're starting to experience a rolling recovery. One big exception is commercial real estate is now experiencing a rolling recession. I think that the outlook for the stock market is clearly going to be tied to the outlook for the economy and the outlook for earnings. And I've got the S&P 500 earnings at 225 this year. And as you know, there's some numbers out there that have been below 200, some at 185. But I've got 225 this year without a recession, obviously. And then 250 next year and 270 the year after that. I think by the end of next year, the market's going to be discounting what is ahead of us. And it might be 270 times the 20 multiple. You have to allow me to really push my limits here on multiple. It gives you 5,400. Why at 20 multiple? Well, it's just empirical. We've got 8 stocks, the mega cap 8, that now account for 27% of the S&P 500. They have a 30 multiple. They try to knock them down to 20. Now they're back at 30. So I think we have to recognize that the old rule of thumb that 15 is fair value for the stock market may not apply when you've got this mega cap 8 phenomenon.
One of the other inflationary considerations, I think, for investors, first off, going through all of these earnings seasons over the last year, I think we saw some pricing power for companies, and maybe that'll be reflected in this latest batch of results. But some people have said, well, if the inflation picture improves, all of a sudden, maybe that takes a little bit of momentum away from the sales picture. So maybe you're talking about a little bit of a stall out in the S&P top line revenue story. What would you say to that?
Well, I would say that over the past year, 2 years, what we've really seen is a mini recession in earnings, and it's been all related to the profit margin getting squeezed. I think that whatever slowdown we see in revenues because inflation moderates will be offset by an improvement in the profit margin. I think productivity is going to make a comeback. I think AI is not the only technology out there that I think has the potential to really dramatically improve productivity. There's robotics, there's automation, there's quantum computing. So I think this is going to turn out to be something like the roaring 2020s. I started to talk about that a couple of years ago, at which point it looked quite delusional, I have to admit. But now I think it's a reasonable outlook for the economy, and I think by the end of the decade we'll look back on it and say, it started out awful, but it ended up awfully good.
Ed, you've written a lot of history yourself as an economist, but you're a student of history as well. And I just want to ask you, unrelated to necessarily the markets right now, your thoughts on Oppenheimer. Did you see it this weekend?
Absolutely. I gave it 3 pluses in my reviews. Every Monday morning, I review movies for my accounts. And so it goes from 3 minuses to 3 pluses. So I can't say enough about it. It was an excellent biopic, docudrama. It was clearly well done. The director did a fantastic job of making us really appreciate all the nuances of what it took to make the bomb, the geo and domestic political consequences of all that. And then the big picture is like, we've created this horrible weapon that has the potential to just undo creation. So it covers a lot of big subjects.
All right, great to get your take on that, as well as obviously the yield curve. Ed Yardeni, movie reviewer and economist from Yardeni Research. Really appreciate you joining us on this Monday. Coming up, speaking of, why AMC is spiking after a judge ruled against its stock conversion plan. We'll talk about the apes next. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our stock of the hour. AMC shares surging today after a surprise court ruling on Friday blocking a stock conversion plan that would have allowed AMC to issue more shares. Its so-called APE preferred shares, which it wanted to convert to common stock, are lower. Let's bring in Bloomberg's Bailey Lipschultz, who has been covering this story. And Bailey, maybe we should start just with the popular arbitrage, which investors have been putting in place and which has prompted this very sizable bounce in AMC stocks. Can you explain what people had been betting on?
Yeah, they had been betting that this one-to-one conversion would go sailing through the courts. The basic thesis is that you short AMC common stock, trades under AMC, and you go long the preferred units that trade under the ticker APE, basically in expectation that this would go through. They would be able to convert for one, and then do a reverse split that would cut the number of shares outstanding quite tremendously and open the door for additional share sales. But the big issue is that when this news came out late on Friday, investors were squeezed. So you had an initial stock spike that basically AMC essentially doubled in post-market trading. So low volume, you had the rebalancing, you had options expiration. So a lot of things unfolded that the initial reaction caused a sell-off or a deep plunge in APE shares and a surge in AMC that's reversed just a bit, but you're still looking at a spread between the two well north of $4, basically double what it was at its bottom back in February.
We're still also looking, Bailey, at meme stocks that have surged over the past few months. Why do you think we've seen this resurgence in stocks that don't make any money or really generate free cash flow?
I think, Matt, it's a lot of short covering. I know we've talked about the likes of Carvana and other stocks that are heavily shorted, very much beaten down. So we're seeing a bit of the casino crowd coming back, whether that's Wall Street professionals or retail traders. When you see the stock market continuing to recoup a chunk of those losses and you're in a bull market, we're seeing a lot of cash coming from the sidelines and wanting to be deployed. And that actually can really add some more gas onto the fire. Again, when you see a stock like AMC common shares right now up more than 35%.
Bailey, thanks very much. Bloomberg's Bailey Lipschultz joining us live from Hoboken, New Jersey. Coming up, Genevieve Fraser of Maven on the global M&A outlook. This is Bloomberg.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and Radio.
This is Bloomberg Markets. I'm Matt Miller with John Ehrlichman. Today's big take focuses on Wall Street firms downsizing as deal volumes crater. Higher borrowing costs and volatility spurred by geopolitical tensions, as well as threats of a global recession, have sent deal volumes down about 40% to a measly $1 trillion this year. The slump has also spawned an epic turnover of investment bank talent. Let's discuss with Maven Research partner Genevieve Fraser. Genevieve, great to have you here in studio. Thanks for joining us.
Thank you for having me.
So we had, not only the collapse of Credit Suisse, which was a huge mover of talent, right? But apparently even Goldman Sachs partners are picking up the phone when recruiters call. Why and where are they going?
Well, it's a very fun time to be in my industry right now. We're popular again, Matt, which is exciting. But I think the bottom line here is that everything is in motion. And that's counterintuitive in a way, because what we might expect in a weak market is a weak fee market is a weak talent market as well. But that's not what we're seeing. We're seeing really strong levels of activity. And in addition, we're seeing what you might call sort of a rewriting of the playbook in terms of hiring. And I think it's driven by a few factors.
So what are they? And is like the compensation side different? Do people care more about working from home? Does that really matter to an investment banker, or is it only just money still?
The work from home aspect is interesting. Most of these bankers are back 4 or 5 days a week now, and if they're not, they're traveling again. So I think it's less due to that. I think that, one aspect is that top talent, rainmaking talent, if you will, has a bevy of options right now. And they felt that they were paid down in 2021, likely for circumstances that were outside of their control, the broader performance of the bank, the macroeconomic conditions, right? Even if their performance was strong, they received a massive reduction in compensation, and they're looking at that again this year for 2023 compensation. So if they can make the trade and they can reset themselves to 2021 comp levels, and then to compound that, they can get a 1 or 2 year deal where they can ride out the rest of the downturn in relative security, it's a little bit of a no-brainer. And then if you look at, on the client side, boutiques through to bulge are still hiring strategically and opportunistically. I would say some are able to lean in more. If you look at the boutique platforms, they're a little bit more nimble. They're able to bring on more talent at this time. But you're seeing them literally expand into sectors where they've never had a presence before. And that's where we're seeing the team move thing as well. People are hiring entire tech teams, entire renewables teams to gain market share. You have the mid-market folks like the Jeffries who tend to always capitalize in markets like this. And they're bringing on very top talent. The foreign banks are looking to enter the US market. And so that's another dynamic here, the BNPs, the Santanders. And then you can't forget about the bulge though, because these large cap banks aren't not hiring. They're just hiring a bit more tactically, and they're hiring even as they're letting folks go. So it's a little bit of an interesting in and out effect, a little bit of a fire and hire effect.
Well, Genevieve, we just spoke to the Wall Street strategist Ed Yardeni, who painted a picture of an economy that might ultimately be in better shape than the biggest skeptics on Wall Street right now. And just to build on what you're saying, and some of this is in the big take piece, but the idea that for these smaller firms to be opportunistic, what if activity does come back in a big way, and maybe a rare chance to get some talent on your team, assuming we're not talking about a sizable contraction or recession, the worry that had been out there for so long?
Yeah, I think it's interesting. I think that you're right, and that all of these places are thinking, okay, we have a shot on goal right now to bring on impactful talent. I think the other aspect here is that people are betting on a boom post-downturn. And so if you look at shops across the street, it's not just the boutiques, it's all the way up, various shapes and sizes. They want a strong bench to be able to capitalize on the M&A activity returning, right? So they want people who can be there and well situated with a full client base so that they're ready to pounce when this happens. And I think that, there are spots of brightness right now. The entire market is not dead. There are areas of client activity. If you look at tech, if you look at software, if you look at renewables, really add tech on to the end of any one of these things, consumer tech, industrial tech, et cetera. And those are areas where there's a lot of client activity. So people are strategically looking at gaining market share there, even before we're seeing the full bounce back of M&A.
Yeah, it's interesting that you've mentioned those sectors a couple of times, because I think a lot of, in the stock market this year, investors have been trying to figure out what does an AI-filled future mean for us, and even in an area like renewables, as we talk more about a green economy, I would imagine if you don't have any historical talent overseeing those boom areas for your firm, well, then this maybe also becomes the opportunity on that front.
Yeah, you are going to be missing out. And renewables is an interesting example because it's a newer sector, right? So anybody who's focused on it is typically, a legacy power energy banker who's now getting into this renewables space and recognizing that there's a multitude of activity here. But if you're not positioned to capitalize on that, you are missing a large amount of fees that are coming with that. And so I think you're absolutely right. I mean, I think that people are recognizing they have these gaps in their coverage, and they're bringing people on, top talent. I would still say it's at the top talent, sort of senior MD level, but they're bringing people on who can then make the impact and move the needle on their platform.
Genevieve, thanks so much for joining us. Great having you here in the studio. Genevieve Fraser is a partner at Maven Research, talking to us about, well, really the moves on the street that we've been seeing. For right now, let's get a quick check on what's going on in the markets, because we continue to see the S&P rise. Really interesting moves here right now at 45.61 as we kick off, really, depending how you measure it, either the first or the second biggest week of earnings for the S&P. We have 165 companies out of that index reporting this week. We have more reporting next week, but a bigger volume in terms of total dollar value this week, over $14 billion, $1 trillion, I should say, of market cap reporting. You do see the 10-year yield at 385. The inversion continues to grow, and we'll continue to follow that story as NYMEX crude marches towards $80 a barrel. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The Dow average aims to make it 11 gains in a row thanks to old economy stocks. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking off to closing bell here in the U.S. and with 2 hours to go until that bell rings, you're looking at an equity rally on our hands. The S&P 500 currently about 0.5% higher, well above 4,500. Then you take a look at the tech stocks, the NASDAQ 100, also seeing gains as well, currently up about 0.3%. We'll see how that changes over the next 2 hours. Meanwhile, the bond market, actually, you're seeing yields climb a little bit here. The 2-year yield currently up about 7 basis points. So a little bit of a sell-off, of course, as we await that Fed meeting on Wednesday. And then you take a look at the euro. Don't usually highlight the currency market here, but this is interesting. The euro weakening for a 5th straight day against the dollar. I don't know what happened to dollar weakness, but you're not seeing, at least against the euro, Scarlett.
Yeah, somebody very smart said everyone's wrong at the moment, and they have been for a while. You mentioned the Fed decision. That's on Wednesday, but the Fed begins its 2-day policy meeting tomorrow. And for the market, a 1/4-point rate hike is pretty much a done deal. The question now is how much will the housing market's rebound complicate the central bank's efforts to keep inflation in check? We're going to get a read on the state of housing in coming days with data on home prices, on new home sales, and pending home sales, all due for release. Now, speaking of rising prices, oil makes a decisive break out of its range. West Texas Intermediate climbing above $78 a barrel, now at $78.85. It's now trading at about a 3-month high as well. Saudi Arabia and Russia's production cuts are starting to materialize and also raise expectations that supply will tighten over the second half of the year. We've seen energy stocks as the best performing group today, and along with financials, they lead the market's gains this month, which is timely given that the biggest oil companies, Katie, will be reporting earnings in the next couple of days.
The biggest oil companies, and it feels like everyone else, because this is the biggest week on the earnings schedule globally. You're going to see this chart a lot this week because $27 trillion of market cap due to report globally this week. Almost $14 trillion of that comes from the U.S. alone. We're talking 165 companies in the S&P 500 reporting earnings this week, and it comes at a pretty critical time for the index. If you take a look at the S&P 500 on a sort of technical basis, well, we know on the earnings front, it trades at about 20 times earnings right now. That's above the long-term average. And then technically speaking, if you take a look at its moving average, its 200-day moving average in the yellow, you can see that the white line, the index itself, has started to separate itself. So a big rally there. And then you take a look at its relative strength index, and we're above overbought levels, Scarlett. So we'll see if some of the numbers that we get in the coming days can justify what we're seeing on a technical level.
Well said, and that sets us up perfectly now for a conversation with Chris Verone. He is head of technical and macro research over at Strategas. Chris, as Katie was just showing us, stocks are overbought right now, and they can stay overbought for an extended period of time. Sentiment, you point out, is running kind of hot right now. Combine those two. We're overbought and sentiment's running hot.
You know, it's the first time we've used that language all year. Our client note this morning said sentiment's starting to get a little hot here, which is a big difference from what the setup was 4 or 5 months ago into the start of the year. And we see it across a variety of indicators. Put-call ratios are very complacent here into a big week of earnings and Fed meetings. Some of the survey work looks more aggressive. We see it with fund flows, which have finally started to perk up here. So I just want to be mindful that the bar right now is probably higher for the market to keep surprising on the upside. Listen, the trend is the trend. The market has had a mind of its own here, but just be mindful. Complacency has started to sit in the last couple of weeks. We've seen it with analyst raises. We've seen it with put calls. We've seen it with surveys.
Do you see it anywhere where complacency still has some more room to go, where it's not confirming this hot sentiment?
Well, I think there's almost this romantic paradox that just as we print 3% CPI, what begins to happen? Energy starts to outperform, grains turn up. It's a very unique market paradox that just as the consensus believes inflation is on the verge of being defeated, you have the commodities start to wake up. I think the breakout in crude is a really big deal. It's all people wanted to talk about a year ago. It's been quiet about them. Gasoline's up 30%. In the last few weeks. I mean, that's a really big move here. Crude above the 200, I think, is a big deal. the perking up of the energy stocks, and more importantly, since the CPI print 2 weeks ago, energy's outperformed tech and it's outperformed consumer discretionary. That's a subtle leadership change underway here.
I want to talk more about crude because you bring up the 200-day moving average, and I swear to God, 20 minutes ago I was having this conversation. Someone pointed out that we're close to that 200-day moving average on crude. Why is that so important?
So we look at it as a trend following tool. It's been, call it 11 months since crude was last above the 200. We failed there several times over the last year. So just in terms of gauging the psychology or the behavior of the market, I think pushing up through 80 on WTI, maybe 82 on Brent, is a pretty important development. But the energy stocks have frankly been articulating this for the last couple of weeks. I mean, the move we've seen in the service names, let's see, Halliburton, Schlumberger, Baker Hughes, they've led this. I also think it's equally notable, while the copper chart's still pretty mushy here, all the copper stocks are breaking out. I mean, look at Freeport, look at Southern Copper. So there's a message here the market's attempting to communicate to us, and I think it's a little bit different than the message that's been in play for the last 4 or 5 months.
And I mean, it's interesting that we're having this conversation because energy is one of the worst performing sectors on the year. It had been the best performer for, I think, 2 years running at least. But I want to go back to what you were saying about sentiment, because when I think of sentiment, then I start thinking about momentum. And it really feels like this has been a momentum-driven stock market. And is momentum alone enough to carry us through the end of the year?
So when you look at all of our trend work, it's obviously positive. All the momentum work is positive. I just want to be a little bit mindful. I think the bar to surprise on the upside is going to be higher moving forward, particularly into a weaker seasonal period. Now, we've done a lot of work on seasonality. It's not that huge of a deal. I don't want to make too much of it. But I think when you look at the kind of stock by stock here, Google's below the 50-day very quietly. AMD has started to roll over. Microsoft got rejected at the old high. So there's some big names here that are starting to suggest, wait a second, we're in a tough part of the calendar. Market's up a lot. At a minimum, I think you could see this consolidate or chop for several months.
So merge the technical with the fundamentals here, because at this stage of the tech stock rally, do the technicals play more of a leading indicator, or are they confirming what we already know?
I think the big question in terms of marrying the technicals and the fundamentals is simply what rates do from here. I mean, rates are coiled right here. You look at the 10 and 30-year yield, you have the 20, 65, 100, 150, and 200-day moving averages all converged between 365 and 370. We're going to get our answer very, very soon. I thought it was interesting today, despite very weak European data, U.S. yields reversed and have now got higher. So there's something coiling here on yields. My suspicion would be a breakout in 10s above 405 or 410 would really set the tone for the back half of the year. My gut says that's tech negative, not tech positive.
Chris Verone, thank you so much.
Thank
Always
you.
giving us something to look ahead towards. Chris Verone is Stratega's head of technical and macro research. All right, we've got a lot coming up on Bloomberg Markets The Close. It is a monster week for central banks. The Fed, ECB, and BOJ all issuing policy decisions on consecutive days. We're going to have the latest, Katie, on what to expect.
Plus, we'll also take a look at Apple planning to hold shipments steady for its upcoming iPhone 15 models, despite the tumult in the global economy.
And Twitter getting a whole new look. Goodbye, little bird. Hello, X. All that and more coming up. This is Bloomberg.
What do you like most about your job? I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes. And so what's your best piece of advice? I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come?
Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
The current situation has done a great job of anticipating a financial crisis. We had that in the banking sector back in March, but the Fed came in so rapidly providing liquidity that it hasn't morphed into a credit crunch and into a recession. And I think what the bond market investors are anticipating now is that we might actually be able to have an economy growing with inflation moderating.
And that was economist Ed Yardeni talking about what he calls a nirvana scenario. And he is one of many of Wall Street's top economists, saying that the risk of a recession is fading fast, even as that yield curve continues to invert. So let's bring in Bloomberg chief correspondent for global macro markets, Liz McCormick, joining us on set. And Liz, I thought that the yield curve was basically telling us that we're all going to die. But it sounds like a lot of people are coming out and saying that's not necessarily the signal here.
Yeah, I always say when my father, who's now just turned 90, asked me about the yield curve, we're in trouble. But yeah, it was kind of good to talk to these people who said, you know, hey, maybe the yield curve isn't flashing, you know, like so much alarm like Ed was laying out. You know, I kind of put it like Ed said, in March, the Fed did a pretty good job of ring fencing what was going on. So we didn't have this broad crisis, right? And Megan Swiber has been really good at predicting and saying the curve is kind of more of showing a hard landing on inflation as opposed to the economy. You know, people pricing in inflation, the Fed's going to win. Now, don't get me wrong. There are people who say we're still going to have a recession, but it's interesting to see these other folks come in and say maybe soft landing pans out.
Maybe that's what we're getting right now, a soft landing, and it's hard to recognize it in the moment. What about Cam Harvey, the Duke University professor who basically came up with this idea that the inverted yield curve is a predecessor to recession?
Yeah, I mean, I feel like I can't do a story like this without talking to Cam. You know, with all due respect, we should talk to him. And he gave me some great data. He said, Liz, it's basically too early. It's too early to say it gave a false signal, because he went through all the recessions back through the early 80s and said every one that was preceded by the curve inversion, but it took sometimes 18 months. On average, it was 11 months from when the curve first inverted till the recession started. So he said it was only, he looks at the 3-month to 10-year spread, that only inverted in about, like really stayed inverted in November 2022. So he's like, it's kind of like 9 months, Liz, so it's too early. So, and he thinks a recession is coming. He's worried if the Fed, and I'm not saying they are, but if they did the 2 hikes that the dot plot was signaling, he said that kind of puts even more pressure on that they're going to kind of make that mistake and push things too far.
Well, we'll see if their plans have changed at all in about 2 days, just over 48 hours. But I think that point by Megan Swiber is really interesting, interesting. And I actually spoke to her on Friday, and she made the point that really, if you look at the curve, it's an endorsement of the Fed's policy. It's the bond market basically signaling that they're confident that the Fed is going to get inflation under control.
Right, exactly. And she almost was saying the market maybe is a little too confident. I mean, she thinks that it'll work, but the market, if you look at the forwards, is pricing in that they get to 2% maybe sooner than she thinks. But yeah, and I've heard a few people say that. They didn't all kind of make it in the story, but same thing, that it's kind of a vote of confidence in the Fed that eventually they'll be able to cut, even if, they will cut rates eventually, even if it's not a hard recession, because they want to normalize. They don't want to have rates at over 5% forever. So the market is pricing in cuts. And but yeah, I kind of think she really nailed it. Hard landing on inflation may be what the curve is doing.
Sometimes I wonder if people are just positing scenarios onto the yield curve, right? It is whatever you want to make it to be, and you can read what you want into it.
Yeah, it's a bit of a Rorschach test, right? You know what I mean? That's why after a while my editors say, okay, there's so many views, we have to narrow down because there are a lot of people who say different things. And there's some bond investors say, hey, come on, this thing is right. Bond market is better than economists, that we're going to have a recession. This thing always works. And then, like, you have the others. So I think, yeah, I mean, Mike McKee, who's coming up later, I know we'll talk about the actual numbers and the economy and what's that showing. And right now we're not in recession, but I know Bloomberg Economics sees one coming. So yeah, we'll see.
That's been the theme for the last couple of months. Liz, thank you so much. Bloomberg's chief correspondent for global macro markets, Liz McCormick. She just teed us up for our next conversation because investors are gearing up for a very busy week ahead, a triple header from global central banks with decisions out from the Fed, the European Central Bank, and the Bank of Japan all on deck. So let's bring in Mike McKee, Bloomberg's international economics and policy correspondent. So last month, the Fed did a hawkish skip. They didn't do anything with interest rates, but signaled that the next move will likely be up. And so we now come upon this week where we're likely to get a rate hike. After that, who knows?
That's it, right there. You just gave my whole presentation. After that, who knows? Liz and I were talking earlier, and we were laughing. She says, is the bond market always right? I said, well, what day of the week is it? Some days they're down, some days they're up. The Fed's going into recession. The Fed's going to have a soft landing. It's really hard to tell. This is just very unusual times. We have a lot going on this week with central banks because we got the Fed on Wednesday, the ECB on Thursday, Bank of Japan. I put them down for Friday, but it's really Thursday night their time. But by the time we get the news. And then you've got GDP, the first look at second quarter GDP, and we've got the PCE inflation numbers on Friday along with income and spending. So we'll have a pretty, not a pretty good, but maybe a much better idea of where the economy is and what the Fed is going to do by Friday. Unfortunately, the Fed is meeting Wednesday, so they won't have that extra information. And so I suspect that what you'll hear from them is as little as possible. They will repeat what they said last time about we're watching the data, basically.
And the Bank of Japan is in their own league. Of course, their economy is very different from what we're seeing stateside. But when you think about the campaigns of the Fed and the ECB at this point, close to the end of their cycles, how similar is the work that they have left to do?
Well, that's an interesting question because the inflation rates in both countries are sort of driven by different things. A lot more energy issues in the in the Eurozone. And the Eurozone, the ECB, is coming from a much different place in terms of its tightening. They started below zero. So while they're only around 4, they're still moved about as much as the Fed. So maybe they can stop soon, but there's sounds like they're about as divided as the Fed is on whether they need 1 or 2 more.
Are they as comfortable with being divided as the Fed appears not to be? Because as much debate as there is within the Fed over how to proceed, when it comes time to making a decision, everyone gets on the same page.
Well, I think they basically have the same situation at the ECB. It's just that they have 29 members instead of 19 or what we're working with like now, 18. So there's always going to be somebody who's not happy with what's going on. But I think the general thrust, I've said basically there's strategy and tactics. And strategy is you want to raise rates until inflation comes down. Tactics is how you do that, how much per meeting, et cetera. And there are disagreements about that, but everybody's sort of on the same page about strategy at this point. They do think they need to raise rates at least one more time in both areas.
And Mike, before we let you go, when you look at these 3 central bank meetings coming up, which has the most potential to surprise?
Well, that's an interesting question because it really there's two things people are looking for. We're looking for the Fed and the ECB to tell us what they're going to do next, whereas the Bank of Japan has already said we're not interested in changing yield curve control for right now. But the Bloomberg reporting out of Japan is that they're going to significantly raise their inflation targets and say inflation is going up higher than we thought. And if that's the case, then that'll pull forward the market in terms of thinking about when they might start to change policy. So you could say that the Bank of Japan, which does nothing, may have a greater effect on market thinking than the others, unless the Fed or the ECB comes out and says, we'll see you in September.
Well, Mike, you're going to have a busy week. Great to get some time with you now. That is Bloomberg International Economics and Policy Correspondent Michael McKee. Coming up, the great M&A slump. Wall Street firms are downsizing as deal volume craters, but some lower-ranked rivals are on a hiring spree, betting that a boom is just around the corner. More from today's Big Take coming up next. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Take focuses on Wall Street firms downsizing as deal volume craters. You've got higher borrowing costs and volatility spurred by geopolitical tensions and threats of a global recession, shriveling deals with volume down about 40% to roughly $1 trillion this year. The slump has also spawned an epic turnover of investment bank talent. Bloomberg's Crystal Z has written the story along with our colleagues in Europe, and she joins us now. So Crystal, you start off with some great anecdotes here about how some investment bankers are looking for jobs or calling around looking for jobs in a way that they never would have in years past.
Yeah, you're seeing big banks such as the Goldman and the Morgan Stanley of the world picking up phones from smaller rivals that they probably wouldn't have picked up earlier. And we're seeing this migration of bankers from big bulge bracket banks moving into boutique smaller investment banks. And that is a variety of reasons. And one of the biggest problem is that M&A volume has been very disappointing so far this year. Is down 40%, like you said, and that translates into bonus. People don't expect this to be a good bonus year, so it may be a good time for them to go to a new place and pick up a new contract and perhaps get a guarantee while they're at it. So that's the reason a lot of people are moving around, but obviously there are more reasons behind that.
I want to talk about why some of the big guys, Goldman, Morgan Stanley, Citigroup, et cetera, are actually cutting jobs in this area. Does that tie back to that M&A volume being down, or is also a case of they got too big too fast?
So a lot of these banks, bulge bracket banks especially, hired a lot of people during the boom in the 2021, 2020 time. That is across investment banking coverage, it's across M&A, it's product like equity capital market, debt capital market. And now you're seeing most of IPO and M&A volume had come down. IPO hadn't reopened until this month. There has been almost 12 months of no IPO. So you're seeing that these people, some of them are just sitting around, not doing very much. And there's only so much you can pitch as well. So it makes sense that some of the bigger investment banks are choosing to downsize, and downsizing more than once. We're seeing some banks have done more than one round of job cuts, and that created a lot of investment bankers in the market trying to look for new places.
So you paint this picture of investment bankers sitting around with not a lot to do. Wouldn't that be the same case if they go to smaller boutique investment banks, that they also don't have a lot to do?
So a lot of people are telling us that it's a slightly different model, because when you go to a smaller bank, it's more of an entrepreneurial model. You get to build your own practice. And maybe when there are not fewer people covering one sector, you get to cover a bigger chunk of that sector. Overall, you get a bigger piece of maybe a smaller pie. So that is, at the end of the day, all economics. You're getting paid off the deals that you are bringing in, and if there's less people like sharing that pie, you're getting more.
And so let's talk about sort of the issue at hand, because I feel like a lot of this conversation hinges on the fact that there's just not a lot of M&A right now. And like you lay out in your story, I mean, some of these boutique firms are betting that maybe that's going to change. But how high are the stakes here? If we're still in this sort of slump 18 months from now, could we be telling the reverse of this story?
So that's a lot of hurdles that we need to jump through, right? It's not just borrowing costs being high. That is impacting both private equity and strategic deal making. We're also seeing a much higher regulatory hurdle here. You see so many deals taking much longer to close. Again, that translates into bonus, because a deal that you're doing this year may not kick in this year. It may kick in a year after, or maybe 2 years from now. So all of these things need to be fixed. And when will regulatory regime changes? It's all entirely hinges on elections, and there's so much that goes into it. So it's not just as simple as once the economic comes back, we will see M&A comes back. So it may be a long time until we see another boom in M&A that we saw the previous years.
All right, time will tell. Crystal, great reporting. Really appreciate your time. Our thanks to Bloomberg's Crystal C. And then we take a look at the markets here on Bloomberg Markets. The close, you're looking at an S&P 500 continuing to hang higher, up about 0.5% or so, Scarlett, but on some pretty light volume.
There's that melt up. The path of least resistance continues to be higher. The Dow is now up for an 11th straight day. And as Chris was pointing out, yields have now moved higher after we saw a sell-off earlier.
Well, we'll see how that transpires as we get into the meat of this week's earnings. A lot to keep an eye on here. Don't go anywhere. This is Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Markets The Close. Let's get a cross-asset check as we head towards the close of commodities markets and check in with Abigail Doolittle.
Well, Scarlett, we have a pretty decent rally going on for commodities, both overall and at an individual level. The Bloomberg Commodity Index right now is up more than 1.5%, and you can see crude oil, New York crude, WTI crude up 2.2%. But look at the big rally that we have going on for the grains. We also have soybeans higher, but I want to take a look at it. Orange juice in a minute, but wheat up 8.6%. A couple of different reasons. There was another Russian missile attack on the Odessa port, but there's very dry weather across Europe, and that's hitting both the wheat and the corn crop yield. So you can see this big rally. And then orange juice up 1.9%. Well, it has hit a record. It's trading at a record high as disease hurts Florida, the Floridian, and the Brazilian crops. Scarlett, haven't talked about orange juice in a long time. It's usually a hurricane topic, but today we do have a record high for orange juice.
All right, Abigail, thank you so much for that summary of our commodities markets. Let's move on to technology and what some people also call a commodity, which is smartphones. The world's most valuable company, Apple, is said to be asking its suppliers to produce 85 million iPhone 15s this year. That's basically keeping in line with the year before. The move comes despite weaknesses in the global economy and a projected decline in the overall smartphone market. Let's check in now with our expert on all things Apple, Mark Gurman. He covers the company for Bloomberg News. Mark, tell us what you learned here, because demand overall is slowing for smartphones, but Apple's not changing its plans.
So here's the deal. In any other year, probably you would see a bit of a down cycle from last year. So they've been at 85 million units for this launch period the last 2 years, right? For the iPhone 13 as well as the iPhone 14. Now here's the difference between the iPhone 15 and the previous 2 models. The 15 is actually going to be a fairly significant upgrade, right? They split their line into 4 models at this point. 2 high-end, the Pro phones, 2 low-end, the regular phones. All 4 of the models are actually getting pretty significant updates, whereas that wasn't necessarily the case the last 2 generations. So even though we're in a tough economy, even though people are saving their money and not springing for new phones and other tech items like they would in a prior year, the fact that these phones are going to be so significant means they're able to remain flat. So overall, that's a good thing, but the rationale behind this is actually how impressive these new models are actually going to be.
Well, tell us a little bit about the new models then. I mean, what should we be on the lookout for?
So let's start with the 2 basic models, the iPhone 15 and the iPhone 15 Plus. They're going to be getting the dynamic island. That's that new area at the top of the phone they added to the 14 Pro and Pro Max last year for notifications, system alerts, and such. So that will be coming down to the lower-end models. You're also going to get camera improvements on the lower-end models. Now, the high-end models is where the real new stuff is coming. That's going to include a new design. So they'll be moving away from the stainless steel design they've been using since the iPhone 10 in 2017. That's the stainless steel band that goes around the sides of the phone where it includes the antennas. That's going to be moving to titanium, matching the latest version of the Apple Watch, right? It's a little bit more premium. You can do a little bit more with color, and it's not as shiny as the stainless steel, so it'll stay a bit cleaner. You're also getting, actually across all 4 models, a new charger. They're moving to USB-C. That is a more ubiquitous charging standard globally. Android uses it, the Mac uses it, the iPad uses it. And then the last thing is a major camera upgrade on the iPhone 15 Pro Max. It's getting what's known as a periscope camera. What you need to know there is that you're getting a much wider range of zoom, better clarity, zooming in using actual hardware components rather than software, so you'll get a better overall image.
Okay, so obviously that'll affect pricing as well. What do we know about pricing for the high end of the Apple iPhone 15?
Yeah, for what I'm hearing on pricing is that at least internationally, you're likely to see some price hikes across all 4 models. And it's possible that those no camera and components in the titanium inside of the higher end iPhones could drive up the Pro phone costs as well in certain markets.
All right, Mark Gurman, gotta leave it there. Really appreciate your time on all things Apple. And let's switch gears here now to arguably the biggest tech story of the day, at least as far as I'm concerned. We're talking, of course, about Twitter. It's becoming X. It's replacing that signature Bluebird as part of Elon Musk's vision of transforming this 17-year-old service into an everything app. Scarlett, I feel like you're not on Twitter anymore.
I am on Twitter, but it's less useful for me now. What I'm thinking now is when they change the branding, the app no longer looks, it's no longer easy to find. It's just a black app with a white X on it. It's hard to see. Like the Bluebird is easy to see.
I really like birds, so I was a little bit sad about this. And I mean, it's so iconic at this point. It's 17 years old. It can almost vote at this point. But I think we're making jokes about the name, the bird, but I think Musk's vision and this as a step to his vision of this everything app, it's going to be really interesting to see how this shakes out. We did see a tweet from the new CEO saying that the everything app they're envisioning is going to be an AI-powered global marketplace for ideas, goods, services, and opportunities. I don't know.
Okay, so that includes everything. My question is, why can't you expand the existing Twitter brand and logo to encompass all that as opposed to rebranding completely? Why are tech companies so obsessed, by the way, with rebranding?
Maybe it has to do with advertising. I'm not sure. I mean, we know that Twitter has been losing a lot of advertising dollars. I don't think changing the name necessarily would fix that, but maybe that's part of the thing.
Maybe clean up the feed instead. Also, Elon Musk is kind of obsessed with the letter X, too.
Yeah, didn't he name his child that?
I'm not sure. There are many children, so I'm not sure which one might be named.
We'll check that off air, but still ahead on this program, earnings for U.S. restaurants kick off this week, starting with results from this morning from Domino's Pizza. More on why investors are more focused on the medium-term outlook rather than the latest quarter. That's next. This is Bloomberg.
Markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Time now for top calls. A look at some of the big movers on the back of analyst recommendations. And we start with Moderna. We had William Blair initiate coverage of the pharma company with a market perform rating. The analyst says that its COVID vaccine franchise declining in the near term, but it notes that clinical trials using mRNA-based doses could be a, quote, key growth driver. Even still, you can see shares off by about 3%. Next up, we have D.R. Horton upgraded to outperform from market perform over at Raymond James. This comes, of course, after the home building company reported third quarter results last week that the analyst called, quote, outstanding. And that was thanks in large part to its $3 billion rental housing portfolio. Shares currently up about 1.7%. And finally, we have American Express cut to underweight from neutral at Piper Sandler after its revenue missed the mark in the second quarter. You had analyst Kevin Barker citing growth concerns, and it expects its millennial age base to experience greater headwinds with the resumption of student loan repayments later this fall. Now, that millennial base accounts for about 30% of Amex customers. For some context, they are currently off about 1.2% on American Express. And those are some of our top calls. Now, speaking of missing the mark on revenue, that's exactly what second quarter results from Domino's Pizza showed earlier today. And yet, investors expect sales to improve in the second half of the year due to promising carryout trends and, of course, a new delivery deal with Uber. Joining us now for more is Chris O'Cole. He is Stifel Managing Director. He focuses on the consumer and the retail sector. And Chris, you have a buy recommendation on shares of Domino's. Is it safe to say that you're focused on the outlook here?
I am. I think the next several months, you're going to see Domino's relaunch or a loyalty program, launch a redesigned e-commerce platform, and then, as you mentioned, we're going to have the Uber partnership. So I think you're going to see delivery sales and carryout sales continue to improve over the next 12 to 18 months.
Well, talk to us a little bit more about that Uber partnership, because when that news broke, it feels like Wall Street was of two minds what to make of it, whether it was really going to be that big of a boost or more incremental. Why do you see that as potentially more than incremental?
Well, so Domino's is the largest delivery provider and pizza provider in the U.S. So they're the largest delivery pizza fast food chain in the U.S. and they don't compete today on the marketplaces. So the marketplaces represent about $5 billion of the U.S. pizza market, and Domino's, which is the largest in the country, isn't even competing today. So they believe of all the market, when you look at the combined marketplaces, that they could generate about $1 billion in incremental sales.
What kinds of customers, though, can Domino's reach through Uber Eats or anyone else that it does partner with that it couldn't before through its own app?
Yeah, that's a good question. There are, based on our survey work, we believe there are several segments of the consumer who rely on Uber and DoorDash and all the third-party marketplaces for food delivery. And so I think as individuals, those individuals go out to the Uber platform and see Domino's being advertised on it, it may make it more top of mind for food delivery than what it otherwise would have been. And so we think you're going to probably see consumers ordering Domino's on the Uber platform that may be less sensitive to price, maybe looking for more of the convenience. And, Domino's is probably going to be the fastest delivery provider on the Uber Eats platform because they're delivering the orders themselves.
Okay. And of course, those fast deliveries will mean higher ratings, which will push it up higher as well. What's the cost to Domino's Pizza by partnering up with Uber Eats or DoorDash or anyone else it does choose to connect with?
So so they haven't really broken out the commission rate that they're going to be paying for the transactions, but it's going to be a percentage of the ticket that their franchisees would pay. But the incrementality of the sales should make it so that it's generating more profit dollars for their franchisees. And so with more profit dollars for the franchisees, it should work for everyone involved.
And Chris, I want to talk a little bit about the stock, up in a big way over the past month, up about 12% or so in 2023. I'm taking a look at your price target right now. I see that your 12-month price target on this stock is $465. Even with the good month that Domino's had currently, shares are trading around $387. What's going to get it to $465 over the next 12 months?
Yeah, I think we're going to have to see evidence that the Uber partnership is driving those incremental sales. I think once we see that and we start to see franchisee profitability improve, you're likely to see more franchisees open units in the U.S. and overseas. And as that happens, you're going to see a higher rate of growth for Domino's than what they've delivered the past 12 to 18 months. So I think you're going to see just the compounding of the earnings growth with the partnerships on the marketplace, also growing their carryout business, which has been quite successful. And then as units open more, or you have more franchisees opening units, you'll see that top line growth that people are looking for. And that should drive the stock up to that 465 level, we believe.
And Chris, of course, you're bullish on Domino's, but what do you see as the greatest risk to this company at this point?
You know, I think the greatest risk is just execution of this plan. The company has been challenged during the pandemic. They were challenged with the driver shortages. I think making sure that their franchisees have fully staffed restaurants and that they can execute on this incremental demand. But if they can do that, I think you're going to see the results from the bottom line.
All right, Chris, thank you so much for joining us. Chris O'Cull over at Stifel with his recommendation on Domino's Pizza. Coming up, we're going to be joined by Brian Furtado. He is Apollo partner and head of Apollo's family office business to discuss his plans to grow that business in the future and more. This is Bloomberg.